On Apple, that was actually offsetting some of the gains elsewhere because they dropped 3% in post-market trade. And then, of course, elsewhere, oil rising. If you look at oil, it's still gaining a touch at 85.2. This is after Saudi Arabia prolonged its unilateral production cut by another month. They also hinted that deeper reductions could be on the cards. So in 30 seconds, we'll see the European market open. But I have to say, all eyes not only on treasuries, but all eyes on that all-important data out of the U.S. Now, for the moment, you can see we're seeing a little bit of a lift across the board. I think we're looking at the numbers. If you look at the companies that have reported so far in Europe, about 69% of them are a little bit better than expected. The two-year yield is one we watch out for. But for the moment, we're seeing gains, and then we see exactly how it pans out. There's probably going to be some sector difference. If you're in technology, you may get a boost like we saw with the NASDAQ. So if you're a European technology company, you may get a boost from that into the trading day. Everything could change then when we have the data out of the U.S. later. Now, a couple of other things we need to watch out for. The FTSE, the first one to open, there you go, straight off the bat, getting some 0.1%. Yesterday was also Bank of England day. They raised, and then we spoke to the governor, Andrew Bailey, and he says, look, it's going to be difficult to actually get to that 2% mark. If you look at pound, 127.14. Again, watch out for gas oil, which is quite linked to what's happening in the rest of the commodities and the sovereign bonds. So look, we cannot underestimate how the big story also with 102 billion issuance of treasuries coming on the markets will impact some of the shorter term. You can see 4.913 for the 2 year. So let's also look at the sectors as we open. Again, things tend to stabilize in the first couple of minutes of the trading day. But look at this chart. It's a beauty. So you look at the European 600 technology stocks, they're gaining some 0.2%. Consumers, retail, energy, all on the up. I guess a little bit of pressure on basic resources. This is on the China story. The China story is one that we need to keep a very close eye on, as the People's Bank of China said it will step up more some of its monetary support for the economy. They've also asked banks to try and do a little bit more. Travel and leisure gaining 1%, probably one of the biggest gainers in today's trading session. All about the jobs markets. Let's get straight to Sam Unstead from our Markets Today blog. And Sam, really, we're kind of in a wait-and-see mode to see what U.S. data shows us later.
Yeah, I think that's right. And I think in particular, because you've had both the Bank of England yesterday, but the ECB and the Fed previously, really trying to emphasize how data dependent their next decisions are going to be. And so the jobs report today, and in the UK, as we go through the next month, and we get we get jobs, we get employment, we get wages, we get inflation, all those things are going to feed into what will ultimately be a pretty interesting set of decisions in the next month.
Hi, Sam. When you look at sterling, I mean, there's quite a lot of going on in terms of central banks in general, and they're all saying the same thing, is that they could stay at higher for longer. Is the concern that actually, from 4% inflation, it's going to be hard to get to 2%?
Yeah, I think that's the concern really across the board. I mean, it's certainly particularly over here with the BOE, inflation is still way above target, right? So as we go over the course of the rest of the year, it needs to come down further. And there's just that little degree of uncertainty. So right now, for the most part, traders seem pretty set that there's going to be a 25 basis point hike in September. But over the course of the rest of the year, there's still a pretty high degree of uncertainty.
So what else are you looking for? I mean, we had quite a lot of earnings. You have all these like confluence of forces, and then we have oil, with the Saudis saying, look, we're sticking to the agreement for now. now.
Yeah, that's right, and I think that's going to start to become more and more of a topic again. You know, not that we've completely forgotten about oil, but you know, over the course of the last month or so, we've had a lot of earnings out. We had the BP CEO saying that demand is looking very, very strong, and then prices are starting to look like they're getting a little bit more bullish again, and that again could complicate that picture for central banks over the course of the second half of the year.
I mean, do you feel like the picture is pretty complicated? Even when you look at China, I know markets have been waiting for this big bazooka, but they have a structural problem. This is unemployment, and so we're trying to do a narrative out of, I guess, 10 pieces of news.
Yeah, and that's why it's so complicated, because there's so many things to go into it, and all of these things also are feeding in for everybody. You know, so particularly energy prices. That's been a major component of inflation over the course of the last year. And you're right, China, and particularly for us, you know, watching the UK market, what's going on in China is very important for the FTSE 100. And so there's so many things swirling around in the global economy.
Yeah, and whatever happens with US jobs will move treasuries, and that moves everything else.
Absolutely, yes.
Is there anything else, Sam? We're kind of catching our breath after 2 weeks of earnings that have been really relentless.
Yeah.
I don't know whether there's a single narrative. I mean, if you beat a lot of the times, the share price didn't really react, because a lot of the good news is already priced in.
I think there's been a bit of more of a focus on fundamentals. So what you're seeing is companies who are doing well on costs, companies who are doing well on inventory control, companies basically who are showing that they can remain sustainably strong over the course of what is an uncertain second half of the year. Those are the companies that are getting rewarded. The ones who are getting kind of more one-off beats, or where the core business isn't doing so well, those are the ones that are struggling a little bit more.
Sam, thank you so much. We can catch our breath maybe after the U.S. jobs data. Sam Winstead there from our Markets Today blog. Now, you can also get more from the team on the front page of Bloomberg UK website, or by typing TLIV GO on the Bloomberg terminal. Let's also get to some of the individual stocks that are on the move with Joe Easton. Hi, Joe. What do you have?
Morning, France. These are how the big earnings stories are opening up today. Still waiting on a price for WPP, but that one is going to open like magic as I continue to talk, I can assure you, and it's going to be in the red as well. In terms of Commerzbank, that one is lower. Not really sure why. That looked pretty positive to me. Better than expected loan loss provision, and also raising their lending guidance as well. Crédit Agricole going the way we expected. A beat on the French retail trading revenue, and that's where the focus is at the moment, given some of the regulatory concern around that market. Maersk, meanwhile, the big shipping company, giving us that negative reading on the economy by downgrading their earnings guidance. So that one is slipping at the moment. Still haven't got that price on WPP, even though I promised we would. Not really sure what's going there, but I did see it indicated down around 10% in the pre-market trading on the LSE. We'll wait for a headline on that one. Anyway, we'll have a look at those Apple suppliers following that negative report from California last night. Now, ST Micro, that's one of their biggest suppliers, gets around 15% of their revenue from Apple. That one just down 0.7%. Nordic Semi, they gave a very weak update to the market a couple of months ago. So perhaps some of this is priced into these stocks already. We're only seeing small declines. Infineon was down 9% yesterday, the biggest drop in 4 years for that one. So as I say, a lot of this weakness in Apple, in chips, potentially already predicted by the market. On the final board, we've got one broker move. I can't do a hit without having some broker moves on there. So John Wood, they've been upgraded by Jefferies. So John Wood upgraded by Jefferies. They're up 3%. Jefferies says that despite a takeover deal collapsing, this one is still worth buying. That's an oil and gas servicing firm. Duffrey, this is the travel retail company where we get all our giant Toblerones and last-minute gifts for our loved ones. That one up 5%, doing some strong sales in the past quarter. And Accor and IHG, that is a read across from Booking.com, who's reported some pretty strong sales overnight in the US, getting a small uplift. I'm just hearing we got a price from WPP. I think we're going to get it up on the screen now. There we go. Down 7% for WPP, the firm founded by Martin Sorrell, who left to start S4. That company issued a profit warning a few weeks ago. It's the latest in a string of profit warnings from ad companies as companies cut back on ad spending due to the declining economy, Francine.
Yeah, not great. I can't believe you mentioned Toblerone before 9 a.m., Joe. That's like...
It's never too early for chocolate, is it?
I know, but I hope someone's going to get some, because now we all want Toblerone. Joe, we could, actually. It's been quite a week. Joe Easton from our equities team, thank you so much for all of that. WPP, as Joe was saying, down 6.4%. Coming up, we'll look ahead to today's U.S. jobs report for clues on what the Fed will do next. And this is Bloomberg.
you say race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress, and somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg.
This is Bloomberg.
This is Markets Today. We're 10 minutes into the European trading day. For the moment, we're seeing a little bit of indecision across the board. Maybe it's the jobs data out of the U.S., but you also have a very different picture in terms of earnings. WPP being slammed after they said a lot of the technology companies are not spending as much on advertising. That stock is down 7%. Technology getting a boost by what we heard from Amazon. Now, it's that time again. Of course, the U.S. monthly jobs report. Well, economists estimate the U.S. added 200,000 jobs in July, slightly less than in June. Joining us with more on this is James Athey. He's investment director at Aberdeen. James, good morning. First of all, when you look at, we've had huge moves in treasuries on the back of Fitch, also on the back of this huge issuance that U.S. will put in place. Like, how important is the jobs data today?
Yeah, good morning, Francine. I mean, it is important for markets. Whether or not we should really ascribe as much significance to these month-by-month numbers as we do is highly questionable. You know, there are many holes in this data, and we know that particularly around these sort of inflection points, it tends to be heavily revised after those first initial prints. But you know, as a market participant, you cannot unfortunately avoid the fact that it is a huge focus. And as you said, just given the moves of the last week or so, it does feel like a lot of markets are on tenterhooks. It's pretty febrile out there.
But even if we see some pretty solid July hiring, I guess it's all about wage growth, because that will, you know, give us more of an idea of what the Fed could do next.
I mean, it is. It's all of the above. The wage growth really is. There's an obvious direct transmission into that price sort of spiral, and so that, of course, is significant for the Fed. But you know, we saw unit labor costs yesterday, and non-farm productivity was significantly higher than expected. And so even if nominal wage growth is optically high relative to the Fed's inflation target, if actually there is an increase in productivity, then that's offsetting from an inflationary dynamic. Unit labor costs at 1.6%, as we saw yesterday. That doesn't suggest that the Fed's got a problem. So there are always sort of complications and questions and uncertainties around these things. The Fed has to obviously consider everything in aggregate. And so focusing narrowly on just a single aspect of the picture, really, I don't think is the way to go. We have to consider everything in totality. From a market perspective, the first reaction obviously will be to the headline, and then over the next seconds and minutes, we start to consider actually what the complete picture is.
But James, do you believe in this Goldilocks, jobs report or scenario? Because we're also getting a couple of bits that could be worrying for economists, right? Hours works have stalled in recent months, and then I don't know whether people are going back to work because they worry about their finances at home. So that could be the negative.
Yeah, I mean, I'm always dubious of the soft landing narrative because it always comes around and it turns out to be false 99 times out of 100. If you go back to 2007, there are lots of references, including from regional presidents within the Federal Reserve System talking about a soft landing. And I don't think what we saw in 2008 could be described as anything close to a soft landing. We saw similar in the early 90s as well. It's very difficult to do by definition. Central banks have very difficult decisions to make about the future using information from the past, trying to land that plane perfectly. History says is near impossible. So I am dubious. It's understandable. The data recently has suggested that the economy is kind of gliding down towards a disinflation without too much damage to growth. I still think that there are huge divergences in the signals between leading and lagging data. I do have questions about the data as well. Again, the jobs data is not necessarily supported, as in the payrolls data is not necessarily supported by other indicators about the jobs market. If you look at gross national income versus gross domestic product, they're telling you a very different story about US growth in general. Tax revenues have fallen off a cliff in a way that's normally a sign that the economy is doing very poorly at a time where we're being told there's an acceleration in consumption. So there are still lots of questions out there. I think when history writes this chapter, it will look like a normal end of cycle. But at the moment, we're in that sort of ideal phase where people can consider that things are going to disinflate perfectly without any damage.
So, James, what's your take on treasuries right now? If you look at the pressure on some of the longer dated paper, I don't know whether or how much of that was linked to investors, digesting this $103 billion of upcoming U.S. debt issuance and really the ability of the market to absorb that.
Yeah, I guess it's probably a combination of factors, and that's definitely one of the more significant. Even once we saw the sort of total refunding and announcement, I think the consensus still got the increase in the auction sizes a little bit wrong. So the coupon auctions were increased by more than expected. And obviously, an increase in 2-year doesn't bring a lot of duration to the market. But if you increase the size of 30-year auctions, that's a significant increase in duration. So I do think that has weighed. But also, again, if we are in a world where the market wants to price a soft landing, which it was happy to do in equities, as we've seen those just crushing everybody and anything again, then the yield curve shouldn't be hugely inverted. An inverted yield curve is telling you that the market thinks tomorrow looks worse than today. So disinversion to try and price more of a soft landing would also make sense. Possibly the downgrade from Fitch played a minor role as well.
What's your take on Bank of Japan? I mean, the steepening of the yield curve extended the trend since Bank of Japan also surprised markets last week.
Yeah, I mean, I really cannot understand or even try and understand the communication policy there. They seem to spend a week or 10 days or even 2 weeks going out of their way to tell us that there was going to be no change to the policy. And then this planted story on one of the news wires at about 2 o'clock in the morning Japanese time, just on the day of the meeting, seemed to change everything. And then obviously we did get a shift in the policy. I'm not quite sure why that would be seen as an ideal way to do things, but the policy was unsustainable, untenable. It was really, I don't think, in any way, shape or form helping the Japanese economy. And the longer it went on, the more the Bank of Japan would look and feel trapped. So I do think they're right to be heading in that direction. If it was me, I would abandon yield curve control altogether and just let the market find its feet. I think the BOJ is a bit too conservative for that. So they are trying to smooth and manage this process. But while ever inflation core is above 4%, buying an unlimited amount of bonds doesn't feel like the right place to be. So potentially there are more changes in the future. In the meantime, again, as you say, that's just another bearish influence for bonds, particularly at the longer end of the yield curve.
All right, James, as always, thank you so much. Congratulations for making it to Friday. It's been quite a week in fixed income. James Athey, investment director at Aberdeen. Now, Donald Trump has pleaded not guilty to charges of conspiring to obstruct the 2020 presidential election. Bloomberg's Kaylee Lyons has the details from Washington.
Former President Donald Trump was arraigned for a third time on a rainy Thursday afternoon here in Washington, D.C., where he pleaded not guilty to 4 criminal counts related to efforts to overturn the results of the 2020 election. Those counts including conspiracy to defraud the U.S. and conspiracy against rights. Now, also at this hearing, the magistrate judge set the date for the next hearing, the first before the judge who will actually oversee this case, Judge Tanya Chutkan. That date is set for August 28th at 10 a.m. Eastern Time. Though the former president will not be required to appear, that is when we understand the judge will actually set the date for Trump's trial in this case. Now, as for what this means for the former president and his ongoing campaign to seek the White House again in 2024, after he left this courthouse and arrived at Reagan Airport, he did briefly speak with reporters and say that this is persecution of a political opponent. And as we have seen in his prior 2 indictments, the charges brought against him have a tendency to actually boost him in the polls. When he was first indicted in the state of New York in that case related to hush money payments paid to porn star Stormy Daniels, his poll numbers went up and he raised millions of dollars. And he has also seen his polling go up since he was indicted the first time federally in Florida related to the classified documents case. So we'll wait and see how this affects his campaign as he is going to face trial dates in the primary season of 2024 and also mounting legal bills as he fights all these different challenges. In Washington, Kaylee Lyons, Bloomberg News.
Now, coming up, Apple drops an after-hours trade as the iPhone maker faces its longest sales slowdown in decades. We dig into their results as well as Amazon's next. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customers like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is Markets Today. We're 22 minutes into European trading day. Look at that. We've seen a bit of a reversal now, seeing gains across the board. Not huge gains, but gains nonetheless, as we, of course, wait for the report of the U.S. non-farm payrolls. Now, mega-cap tech companies, Apple and Amazon, have reported quarterly earnings, with the e-commerce giant surging in late trading. Well, the Amazon chief executive, Andy Jassy, commented on the company's growth potential.
You know, I think that the business has grown to be pretty large already. And I still think we only have a fraction of the features that we need. I don't think we're close to being done growing there, and that is a very strong area of focus for our stores team and for our senior leadership team as well.
Well, Bloomberg's tech reporter, Aggie Cantrell, now has more on this. So, Aggie, good morning. Thank you for starting early. What has led to Amazon shares actually trading higher today?
Yes, so essentially, especially the focus on AWS, which is a real driver for the company's profits, is a crucial part of this. It's important to see how AWS is going to develop going forward. We've seen the huge shift to the cloud, and AWS has really been a leader in that, getting people to switch from on-premise solutions to cloud solutions. And Amazon Web Services has been able to gain a lot of customers that way. But there is a need now for them to potentially offer something new, and AI is going to play a big role in that. So it's also a concern going forward how AI applies to AWS, just as Microsoft is playing the same game with their cloud product, Azure. And as well as that, we're seeing that investors are happy that they are still trying to keep down costs. They have made capital investments of $50 billion this year. That sounds like a huge figure, but it's actually $9 billion less than last year. And that is also something that the market is welcoming.
I do need to correct myself, actually. So extended gains, 10% in post-market trading, and I think we start, pre-market in about 30 minutes for Amazon. How is Apple being affected by the broader slump in smartphone sales?
Yes, so when it comes to Apple, we have seen that the smartphone market across the world has seen a decline, especially because consumers are keeping hold of their old devices and not wanting to replace at such a rate because of a broader concern around inflation and consumer sentiment. That is something that is affecting the whole smartphone market. For Apple, it is a company that is so reliant on iPhone sales. Over 50% of the company's sales come from the iPhone sales, and that is a crucial issue for them. And we have seen them have 3 straight quarters of sales decline, and they are projecting that this current quarter will also see a sales decline. That means that that is the longest period that in the company's in the last 20 years of the company's history, for the entire history of the iPhone, that Apple has seen such a decline in sales for such a sustained period.
Aggie, India and China, bright spots in the Apple results. What can we learn from the company's strength in these markets?
Yes, so this is actually something I find really interesting, is that especially when we look at China, for a long time, China's relationship with Apple was one of the producers, the suppliers of the parts and the producers of the iPhones. Now they're seeing them as a retail partner, as consumers of their products as well. Of course, that also includes Hong Kong, where they have had a presence for a long time. But also, it's important to see as well that this is a play that they've made very recently in India, and it seems to be paying off. They recently opened their first retail store in India, and that's something that they have been wanting to push for a long time, to tap into that huge consumer market. And it seems that while they're seeing slumps in other parts of the world, these massive economies are offering Apple a lot of new consumers.
Aggie, as always, thank you so much for joining us. Our Bloomberg tech reporter, Aggie Cantrell, there on Amazon and Apple. Now, coming up, what the Bank of England's latest hike means for the UK economy. We also talk, of course, markets. If you look at equity, European equity stocks, for the moment, they're actually rising. Again, Treasuries also stemming a sell-off ahead of that U.S. non-farm payroll report. So it's a big one. We'll have a full roundup of the top economic news. That's next, and this is Bloomberg.
Connection lost.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site, whereas this we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
Well, this is Markets Today. We're 30 minutes into the European trading day. Now, these are your top stories. The Treasury sell-off takes a pause, but the rapidly souring mood in world bond markets raises the stakes for today's much-anticipated U.S. jobs data. Amazon shares soar in late trade after its outlook topped estimates on strong e-commerce sales. Apple is down on lower than anticipated quarterly iPhone sales. And in banking, Crédit Agricole soars as the lender reports a surge in profits, while Commerzbank drops despite raising its outlook for lending income. So let's have a quick look at what European stocks are doing. We opened with a bit of a mixed picture. For the moment, we're holding on to gains. Are they gains? Are they unchanged? Let's be kind and say they're actually gains for the moment. But traders really awaiting that U.S. jobs data. Again, if you look at Friday's non-farm payrolls, this is a big one. Of course, forecasts to show that the U.S. added some 200,000 jobs in July. That will probably move treasuries that have moved already quite a lot yesterday. If you look at the 10-year note, they were at a fresh 9-month high as investors digested also the news of that $103 billion in U.S. debt issuance. Don't think this doesn't have an impact in Europe. So for the moment, a lot of these stocks are trying to digest some of the earnings. I think WPP, one of the biggest losers, certainly on the FTSE. And then we look at earnings, we look at the forecast going forward and try and figure out what that means for inflation as a whole. Let's also take a look at some of the sectors that are on the move. Technology, now this is an interesting one because Amazon pre-market was up 10%. And actually, yeah, after they put the earnings out and after the market closed. So we'll see how they open pre-market. But technology was gaining at the open. It's now 0.2% lower. The other stories, of course, what we're seeing with oil and then banks. This is interesting, gaining some 0.3%. Now, the Bank of England has hiked for the 14th meeting in a row. But the governor, Andrew Bailey, says it's too soon to declare victory in the battle against inflation.
Which obviously where policy is really doing the work. And we're going to have to see policy stay restrictive. It's going to have to remain restrictive to have this effect of bringing inflation down, and particularly next year.
Well, joining us now is Paul Hollingsworth. He's a chief European economist at BNP Paribas. Paul, great to have you here in the studio. Now, Bank of England, 25 basis point hike, you expecting 50. Do you think it's a policy mistake?
It's a good question. I think we can only tell in the fullness of time whether it's a mistake or not. Yeah. I think a couple of things. Firstly, we need to put this into context. We've had quite a long tightening cycle now. We're over 500 basis points deep into the tightening cycle. So 25 here or there is probably not going to make the overall difference. But if you ask me where the risks are, so we have one extra hike in our base case. We think they'll still go by 25 in September. If you ask me, the risks is that they probably have to go a bit further than that, as opposed to them having done enough already. And really, this comes down to that strength that we're seeing in the labour market, the strength in wage pressures, which are still quite concerning.
I mean, the language in the press conference and actually in the statement they put out changed a little bit, right? They talk about risks being crystallized, and they're basically saying, look, it makes more sense for the moment for them. They didn't talk about a pause, but they hinted at a possible pause, but staying higher for longer. I mean, theoretically, is it just more prudent to wait and see that, you know, by the next time that they meet the MPC, they'll have 2 inflation datas and 2 government reports as well?
Yeah, I thought it was interesting, this characterization of the different paths that the Bank of England could take. Essentially, if they have a number of options, they could decide to keep rates on hold for a prolonged period or take rates further and then cut them a bit earlier. And what was interesting, if we go into the projections that they released yesterday as well, that under these 2 different scenarios, inflation was more or less identical. So they have this optionality. I think the reason they have that optionality is we're now much deeper into the tightening cycle, so the risks of over-tightening are perhaps a bit more prominent than they were maybe 6 months ago. And also inflation is coming down, headline inflation at least, so there's a bit more confidence that things are in the right direction.
Taj, I guess the million-dollar question is, are you seeing in parts of wages a spiral? Because as soon as there's a spiral, that's when it gets really tricky.
I wouldn't characterize it as a spiral, but it's still inconsistent with inflation at 2%. If I look at momentum in private sector earnings growth at the moment, it's close to 10%. Now tell me how you get to 2% on a sustainable basis with wage growth still running in that kind of region.
But so private sector wage growth is actually the one thing that they're still confident that I think it gets to 6% by the end of the year. Is that even a possibility? I think we're around 7.7% at the moment.
I think it's going to be a tall order to get a sharp change in the very near term.
In 3 months.
In 3 months. If we look at the survey evidence, it's suggesting that things are still accelerating on that front. So whilst we would expect some softening, we think the economy is going to weaken probably a bit more than the Bank of England expects over the second half of this year. I think there is potential for still some upside surprises when it comes to wage data.
Are you concerned about what kind of growth we'll get in the UK? Again, I know that there's, you know, a lot of economists oscillate between very moderate growth or very mild recession. At the end of the day, does it make a difference of the quality of the economic kind of landscape they're trying to build?
There's always this question of, does the UK need a recession to bring inflation down? I think that if we take a step back, the starting point is the economy hasn't really grown for the past year. So with the Bank of England saying the underlying trend at the moment is somewhere in the region of 0.2% quarter on quarter, it doesn't take much to put us into recession. Now, our view is this cumulative tightening that we've seen will put the UK into recession around the first half of next year. Quite a mild one, but again, the overall picture is one of a pretty sluggish economy, but it's still generating inflationary pressure. That's the problem for the Bank of England, is weighing up that weakness in the economy and the strength of inflation.
Do they need a housing crash?
I'm not sure they would want a housing crash. And I think, of course, you know, an adjustment in the housing market can either come through a fall in prices or through a prolonged decline in real terms. And that's kind of what we've seen. There has been quite a big correction already in real terms. But clearly, the housing market is one of the key elements of the transmission mechanism of monetary policy. So some weakness there would give them some sense that what they are doing is working.
Yeah, and you see a switch actually to a lot of, for example, you know, mortgage holders or first-time buyers trying to get to mortgages on 40 years. And again, that's not helpful for the transmission mechanism.
It dampens it for sure. I think one of the points that the Bank of England made yesterday was that may be starting to run its course now. There's only so long that people can extend their mortgages. You know, there are plenty of things available here to try and smooth the shock that people are seeing now. But fundamentally, you know, some weakness, I think, in the housing market is going to persist for quite a while longer, given that scale of policy tightening that we've seen.
Paul, the language that the Bank of England yesterday used is very similar to what we heard from Christine Lagarde at the ECB. Is it because they're trying to change the communication, how they talk to markets?
I think we're just moving into a new phase of the monetary policy tightening cycle. You know, when we began, it was all about the pace. It was about we need to get on top of these inflationary pressures. Now rates are a lot higher. We're in restrictive territory. There's more uncertainty about whether the risk of over-tightening is increased. And if I compare the two, the Bank of England and the ECB, very similar language. Our view is that the ECB is now on pause. We don't think they will deliver another hike in September. We think the Bank of England has probably got one more to go, but we are generally getting to that phase where there is a shift in emphasis towards the duration of restrictive rates rather than the level.
But how difficult is it, a Bank of England governor, being a Bank of England governor today? Again, you had the surprise from the BOJ, you have a lot of focus on the Fed, and at the end of the day, the UK is a very small, open economy.
It's difficult. It's a difficult job for sure. I mean, the UK has been buffeted by a number of shocks over the past few years. Brexit has been probably an exacerbating factor on many of these shocks. So it's really difficult to try and balance this weakness in the economy and the strength of inflation that we see at the moment. But fundamentally, the Bank of England has one job, which is to bring inflation down. The starting point is not great at the moment, and I think it does still need to see a lot more evidence that those underlying pressures are turning before it's time to declare victory.
Paul, thank you so much for all of the insight. Paul Hollingsworth there, Chief European Economist at BNP Paribas. Coming up, 4 months on from the collapse of Credit Suisse, well, Swiss banking is back to making money, and there are a few signs anything will change. We have more on that next, and this is Bloomberg.
Was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
The top names in global leadership are on Bloomberg.
We have reformed the whole ecosystem around attracting foreign direct investment.
To get everybody to the table was the most difficult thing. Now we're here. The next is consummation.
The commitment is there. Now what we need to see is the actions.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority. The Fed is hoping for slowing job growth, but too much could spell trouble.
There is no way that many people would have predicted the kind of data that we witnessed.
Things have slowed down, but they're not falling off a cliff.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
Which nominal wage growth does the Fed need to see?
At what point do people start to say, this is not sustainable?
Maybe this will be the turning point. The July Jobs Report, today on Bloomberg Television and Radio.
This is Markets Today. We're 41 minutes into the European trading day. Across the board, a bit of tentativeness, I would say, in some of these stock markets. A little bit mixed. Again, treasuries fluctuating. We have the U.S. employment data, that all-important U.S. non-farm payrolls. And, of course, it will be scrutinized very, very carefully, very closely for any clues on what the Fed does with interest rates. Now, let's get a check on some of the individual stocks that are on the move with our Joe Easton. Hi, Joe.
So these are the biggest decliners after about half an hour of trading. Fran, WPP, the obvious one, cutting their earnings guidance amid a slowdown in spending by their tech clients in the US, and a bit of a warning that China's not coming back online as quickly as they had hoped. Analysts at Morgan Stanley predicting a 5% cut to earnings there, and that's the biggest drop for about a year for the big advertising company here in London. Commerzbank, meanwhile, figured out why this one was down. It was a bit confused why that one did decline at the open, but apparently the buyback detail is not as much as people expected. People wanted more granular detail on how many shares they're going to repurchase over the next year, and they didn't get that, according to my colleagues reporting on the terminal. Meanwhile, Capita, this is the big UK outsourcing firm. They do a lot of call centres and also have contracts with the UK government. They've put out a profit warning. They've recently had a cyber attack. That stock's the worst stock in London, even more than WPP. That's a smaller stock, though, only around £500 million market capital now for that one. Finally, on the losers, we've got Maersk. Now, this one, they have given us a pretty bad warning on the global economy, cutting their forecast for shipping in terms of that firm there. We spoke to the CEO of Maersk earlier today. Have a listen to what he had to say.
Our case is not for a recession, but it is for a really subdued environment that will continue for the rest of this year, and something that we will have to review a little bit when it comes to our expectations for 2024, but certainly not a strong rebound.
So Maersk CEO speaking there to Bloomberg. That stock down around 1%, as I mentioned. But these are the gainers we've got in the gambling space. We've got Flutter, the owner of Paddy Power, company that I know all too well. They're getting a read across from DraftKings over in the US, which has given some guidance after the close. They've got a couple of deals with the UK firms. That stock jumped in New York after hours trading, pushing up Flutter, and also Entain here in London. Dufry, meanwhile, the Swiss travel firm, they're telling us that people are still spending in airports. People are still picking up gifts, spending on products as they head to get on planes. And speaking of travel, we're also seeing a gain in Air France, the travel sector, the best performing sector in Europe today in terms of the industry breakdown. Now, we also had Booking.com in the US last night. That stock jumped 12% in New York after hours after they upgraded their guidance, also telling us that the travel industry not yet seeing that slowdown. Finally, Crédit Agricole, this one was more clear. They're doing really well in some of their businesses in terms of their lending to commercial markets. French retail, not as strong as expected, but the deputy CEO spoke to Bloomberg today about the mix of their businesses. Have a listen to what he had to say.
The Italian market, where we have a significant operation, we think that we are now close to reaching the peak in terms of improvement of the net interest income. So going forward, what is going to lead the future development of the top line is going to be A, the volumes, and second, the capacity of developing further the fees, which is the other component of the revenues in our banking activities.
Well, on the banking activity side, Jérôme, I mean, you've defied some of the slump we saw on Wall Street for FICC trading, declining only 1.1%. I know last quarter, the investment bank had a record thanks to all of your clients who want hedges, who are worried about this market. Are you still seeing that same demand when it comes to hedging products?
Yes, actually, the fact that we are now in a situation where rates are significantly positive, and this is probably going to last for a certain amount of time, we think that this is leading to a situation where actually the demand of our customers to engage into hedging operation is going to be structurally better. And whereas at the same time, we have improved further our positioning towards our client, all these two elements are very positive for the development of the revenues at CACIB. And this is why actually we've been able to hold the top line at CACIB more or less to the same level where it stood back 1 year ago, where we posted a record level of revenues. So clearly it's a positive evolution for CACIB this quarter again.
So the Crédit Agricole deputy CEO, pretty upbeat there, and we are seeing that reflected in the share price, up about 5% now, the best performing stock on the stock 600 today. But the other gainers really, Fran, telling us that despite the economic downturn, we are still all travelling and also potentially gambling as well. Those are where the strong points are in the market this morning.
Well, yeah, it's true. We are traveling. Joe, thank you so much. Joe Easton there from our equities team with some of the top stocks to watch this Friday. Now, Credit Suisse was an icon of the Swiss economy. Its collapse was a huge blow to the national psyche that many thought could trigger a profound change to the way the country works. 4 months on, Swiss banking is back to making money, and there are a few signs that anything will change. Oliver Crook reports.
The demise of Credit Suisse ripped through financial markets, and it shook the nation of Switzerland to its very core.
It was no longer possible to restore the necessary confidence, and that a swift and stabilizing solution was absolutely necessary. This solution is the takeover of Credit Suisse by UBS.
UBS intends to downsize Credit Suisse's investment banking business and align it with our conservative risk culture.
Despite outrage, shock, and disappointment, months later, silence has fallen back over the Alps. The question, is this Swiss serenity a sign of stability or of complacency? Switzerland is not known for swift changes. Women, for example, only got the right to vote in 1971. And with a closed-door, government-brokered deal, backstopped by taxpayers, many had hoped that the rescue by UBS would be a catalyst for change. Perhaps the federal elections in October could offer an opportunity for debate, but many feel that moment may have already passed. Another concern, Switzerland is a very small country, but its banking sector underwrites financial risk all across the world. Now, UBS total assets stand at 198% of Swiss GDP. On the surface, all is calm. Unemployment unmoved, inflation the envy of every central bank, and the money in the banking sector, it still flows. But if crisis does arise, does Switzerland have the firepower to meet it?
Bloomberg's Oliver Crook there with a look at the aftermath of the Credit Suisse collapse. And you can read more on today's Big Take. Just go to NI Big Take Go on your terminal or visit Bloomberg.com. Coming up, China vows to step up its support for the private sector. We'll dig into what that means for markets. That's next, and this is Bloomberg.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone. Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
This is Markets Today. We're 52 minutes into European trading day. I think markets are just trying to latch onto something. I mean, they were down a touch. They're fluctuating a bit. Now they're seeing gains across the board with the CAC 40 getting some 0.4%, but really it's all about the U.S. jobs number a little bit later on and what clues that gives traders about what the Fed does next. Now, 9:30 a.m. here in London, what we get is UK construction PMI for July. Then in the early afternoon, it's the BOE's chief economist, Hugh Pill. He speaks. That comes after the central bank yesterday lifted rates to 5.25%. Over in the U.S., later, of course, the number of the day, the latest non-farm payrolls at 1:30 p.m. UK time. And at the same time, there's an update on the unemployment rate in Canada. So let's talk about everything that's happening in the markets. I'm delighted to be joined by Sofia Ortega-Costa from our MLive team. Sofia, good morning. Happy Friday. I feel like TGIF, it's been quite a week in terms of treasuries, in terms of BOJ and everything that happened in between. But today, it's really all about that jobs number.
Yeah, exactly. And volumes are actually quite low in Europe. We were looking at this week. What a week it's been in terms of how the macro narrative has changed so quickly. You know, July was all about disinflation, soft landing, really kind of risk on for markets. This week, you know, the BOJ, the Fitch downgrade of the US, really kind of throwing cold water into the markets. And the BOE hiking as expected, 25 basis points. At least they didn't shock the markets yesterday. And now people are kind of looking ahead what's next for its September meeting. I do think, yes, today's non-farm payrolls is a big number, but next week, the US CPI is the big one as well. What I'm hearing is that people don't really want to have too much risk going into the weekend. It's very much kind of let's breathe, let's take a moment, look to see what kind of macro themes to trade going into next week, and inflation will be the next key catalyst, Ran.
Yeah, and if you look at, Sofia, I mean, you know, it's either a Goldilocks kind of scenario, so, you know, we'll have kind of a no landing or a soft landing, or you could see in this jobs data, you know, it's wage growth. It's people going back to work because they worry about finances at home. Are there any of these small indicators that we should worry about more?
Yeah, exactly. And for me, what's interesting is given the kind of mentality that we're in markets right now, if we do get a better than expected number, because the number is expected to be the weakest since 2020, but if we do get a better than expected number, how will that be read by the market? What kind of narrative will that kind of feed into? Is it the no landing, soft landing, disinflation story? Is it, you know, actually a Fed pause? You know, the Fed pause story is going to kind of be reinvigorated. I think it's really kind of depends how the market feels. And this week, the market feels a little bit less confident about all that, Fran.
Yeah, so, I mean, the market, it was a funny old market, actually, this week, and that's partly because of Fitch and this $102 billion issue. I mean, you think about it, it's like $102 billion on the market. Do you think the market has overreacted, or have they really almost taken it in their stride?
There was a really, really big sell-off, especially in the long end of the curve, Francine. I mean, people are saying we did have Bill Gross on one side, Warren Buffett on the other. Really, people really kind of, I mean, my Twitter was kind of fired up around this debate, right? Everyone was saying, you know, we're kind of short this market, we're long this market, this was oversold. I mean, I think again, people are looking for anything that will validate how they feel. So whether it's the jobs number, whether it's CPI, it's a market kind of looking for validation, and it's a market that's kind of divided right now down the middle. Is the kind of short treasury trade back on? Are we going to get more curve steepening into next week? I think there's a lot of questions to be answered, and people just don't want to be, you know, it's kind of, what was it, degrossing? The degrossing theme? I think we're there also in the fixed income market.
I mean, I think Elon Musk was also weighing in on T-bills. I mean, it was just bizarre. And like, you're the queen on Twitter. Are you on Threads? Is there like a subsection of fintech?
I'm terrible with social media, actually. I'm only good on Twitter, so it will take me a while to go back to Threads.
Okay, you have like 500,000 followers. Sofia, thank you so much. Sofia Ortega-Costa there from our Markets Today team. Now, that's it for Markets Today. You can get insights from us and the rest of the team, of course, on the front page of the Bloomberg UK website, or by typing TLIVGO on the Bloomberg terminal. Good luck for the rest of the day. It's a big one with the data. The Pulse, of course, is up next, and we continue talking treasuries and non-farm payrolls. This is Bloomberg. what do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Three prime ministers, 4 chancellors, an energy crisis and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Of course, the conversations that matter, and here's what's coming up on today's program. The Treasury sell-off pauses, but the souring mood in bond markets actually raises a stake for today's much-anticipated U.S. jobs data. Well, Amazon's outlook tops estimates on strong e-commerce sales. Apple posts lower-than-expected quarterly iPhone numbers. We'll dive into these figures. And the Bank of England governor tells me it's too soon for the UK to declare victory in the battle against inflation.
It's the last mile, which obviously where policy is really doing the work. And we're going to have to see policy stay restrictive. It's going to have to remain restrictive to have this effect of bringing inflation down, and particularly next year.
Well, let's take a look at the European markets map. Now, they have been fluctuating quite a lot. For the moment, we're seeing gains across the board. The CAC actually gaining 0.5% here in the UK on the FTSE 100. Just look out for WPP. It's been we're going through a pretty big sell-off, and this is because they said that a lot of the tech advertisers won't spend as much on advertising going forward. The DAX gaining some 0.4%. Look, there's one thing that all of these market traders and all of these market participants want to know, and that's exactly what happens with U.S. jobs. That'll be a little bit today, not only the number, but also wage growth. And of course, it will influence, presumably, what the Fed does, and that could change everything. We've had a very big week for Treasury. So let's look at the 10-year for the moment. But if you look at Treasuries, I want to look at the 10-year and the 2-year. The 2-year, of course, more sensitive to interest rate decision. Look, if you see some of the big moves that we've seen, partly it's also investors trying to digest news of the $103 billion in upcoming U.S. debt issuance. And there is a little bit of concern whether the market can actually absorb all of that supply. You can see the 10-year currently 4.1770, so it's stabilized a little bit since last night. Now, the other story is the food index. This is the United Nations July FAO food price index, and it's risen, or it's rising to 123.9. We'll have a full breakdown, of course, of what we're expecting in terms of, for example, grain prices and supply because of what's happening in Ukraine and Russia with wheat. Now, let's also move on to tech. Amazon's latest revenue forecast topped estimates. Apple's results not so solid, with a third straight quarter of declining sales. So let's get straight to our Bloomberg tech reporter, Aggie Cantrell. Aggie, good morning. So what were actually the key takeaways from Amazon?
Yes, so Amazon, AWS is really the focus for Amazon. It is their real growth driver and has been for quite a while. It's really important to see that Amazon is also a company that has really driven, even though we all know it as the online marketplace for everything, it's really actually AWS, which they see as a real play going forward. And especially once we've already seen so many companies shift from on-premise to the cloud, there was a fear around the growth driver that was AWS because you've already got those customers for it. But actually now what we're seeing is essentially you have been able to manage to also look at how artificial intelligence can play into continued development of cloud infrastructure. And that's the same as we've also been seeing with Microsoft, and that's their big investment in OpenAI. With Azure, that was all about their cloud infrastructure. And you see this with Google as well.
So how is Apple being affected by the broader slump in smartphone sales?
Yes, so the real concern with Apple is essentially they have iPhones that is a critical part of their business. This is over 50% of all their sales are iPhones, and they are seeing the effects of a broader slump in smartphone sales that has essentially come because consumers are worried about their bank accounts, they're worried about inflation, and they're holding on to old devices, and there just isn't the same market as there was before. And that's a real headache for them because really the thing is for Apple is that they're releasing new iPhones. They're releasing one soon, but they're also projecting that this slump will continue into this quarter. And those 4 consecutive quarters, if this current quarter also sees a slump in sales, that will be the longest time that they have had without any with declining sales in the last 20 years.
Aggie, thanks so much. Our Bloomberg Tech reporter there, Aggie Cantrell, with all of the earnings news that we had over the last 15 hours. Now, joining us to explore both tech and the wider markets, BlackRock Senior Investment Strategist Laura Cupo. Laura, thank you for joining us. I don't know what you do with tech right now. So tech is one of, I guess, the most exciting but also concerning in terms of valuation sectors that there could be.
Well, I think there is still scope for the tech rally to extend, perhaps not at the momentum that we have seen year to date. Earnings did come through a little bit above expectations. If we look at the surprise around those earnings beats, came in about 9%. And if we think about, is there actually profitability, cash flow behind this AI hype? Clearly that is the case. And if anything, there's probably a bit more upside to those earnings. That certainly was some of the guidance that we saw from those mega cap companies. And as well, if we think about kind of the CapEx spending, that's going to be a crucial gauge to watch in the coming months. And I do think there's probably still scope there, especially given the broadening out of that rally. We really need to see more improvement in the cyclical side, and we're not yet seeing that come through.
So when could that come? Is it difficult to call?
I think it is difficult to call because markets seem to be already pricing in that so-called soft landing. We are seeing some signs of improvement in some of those cyclical gauges like auto sales, housing is surprising, but then manufacturing in the US has been in contraction for about 9 months. And we do think that as those rate hikes really continue to weigh on financial conditions, that is going to prompt a deterioration in that economic data. So those cyclically sensitive sectors of the economy we think are going to continue to be under pressure. And so getting exposure to those equities that are tilted to that, we think is too premature.
Laura, I know you don't talk individual stocks, but let me tell you about our big number because it's a good number. And this is basically the Apple $1 trillion valuation, which is at risk. Is there, I mean, if you look at what is priced to perfection, so we chose Apple just as our big number because it's the new thing we're doing this week. We love just to pick a big number, but is there a big sector that you worry about in terms of price to perfection away from tech?
I mean, I think if we think about, the consumer discretionary, the communication services, those heading into the earnings season, had fairly upbeat estimates. We think they're going to struggle to materialize those 12-month forward earnings expectations because we do think the consumer is going to be under increasing challenge. Where we are looking for opportunities, though, is where those sectors are already pricing in that recession risks that we do see come through. So whether that's energy, for example, with very depressed expectations, valuations, depressed valuations, and as well looking for those other pockets. For example, industrials in Europe have been fairly resilient. They've participated in that upside despite German manufacturing being in contraction for quite some time. So there is potentially still upside there because of the sector composition towards airlines, towards growth demand tilt. So probably more opportunities in those sectors that aren't pricing in that perfection.
Okay, so interesting. All right, the U.S. jobs number. This is like the big number, non-farm payrolls. Do you worry that there's underlying small trends that actually there could be a downturn in the economy that may not show up in terms of that U.S. non-farm payrolls number?
I think that is actually the case. So yes, we're probably going to continue to see this moderation in the pace of hiring gains. Yeah. Crucially to watch will be those wage components. So average hourly earnings should start to decelerate more meaningfully at the margin. That should provide some lift to the Fed. But ultimately, the unemployment rate still kind of that 3.6% mark, historically low. We could start to see further pressure on that because we do think that that is artificially kept down because of the supply constraints that are coming through in the economy. We've started to see some of that labor force participation come back in the working age population, but on a whole, we do think there was a structural shift in that supply that we're not going to get back to those pre-pandemic levels. That has implications for the broader kind of labor market where that number is probably misleading in some sense.
So interesting, Laura. Thank you so much. Laura Cooper stays with us. Coming up, the Bank of England delivers its 14th straight rate hike. More from our interview with the governor, Andrew Bailey. That's next, and this is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think they're much better than when I was growing up. There's so many people who've occupied areas and I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
We do see policy now as restrictive. Interesting, I think the Federal Reserve and the ECB have said something similar in the last week or so, actually, which means that we do see policy acting to bring inflation down. It's having the effect that we now, and of course, there's a lag in the transmission of policy, so it's not a surprise that we've had to wait for a while for this to happen. But we see the evidence now, so that gives us a sort of basis for now saying what's going to happen here on. And what we're really saying is, look, it's going to have to remain restrictive to have this effect of bringing inflation down, and particularly next year. This year we're going to see inflation come down rapidly, but a lot of that is the unwinding of things that happened last year, energy and so on. It's the last mile, if you like. I use this sort of term sort of a bit loosely. It's the last mile, which obviously where policy is really doing the work, and we're going to have to see policy stay restrictive Now, the question then is for how long?
Right, that's the question.
Now, I'm afraid the answer is, of course, we don't know at the moment. That's why we say for sufficiently long to have its effect, because it's too soon to judge really how long that's going to take. And the reason is that I think, because we've now, I'm much more confident now that it's on the downslope. But of course, people want to see that. They want to really believe it. They want to build, and then it gets built into people's expectations. It gets built into price setting. It gets built into wage setting. We've got to see that happen.
But Governor, so do you believe it? Could you say actually you're victorious right now?
No, I'm not going to say we're victorious. That would be, I think, far too soon to say that. What I see is much more solid evidence that it's coming down. We've been, in a way, the number we had a couple of weeks ago, we've been waiting for this number for some time because there are a number of puzzles to us in the inflation numbers, which just didn't seem to really reconcile with what we were hearing. And this gave us more confidence that we're seeing it.
But why put that wording in the guidance? What are you worrying about?
Well, I think what we're saying to people, there's a path in the market where rates go up and then they come down. Yeah. There's another path which we laid out today for illustration where, well, what happens if you keep rates essentially where they are today? Now, interestingly, both of them return inflation to target, and there's no doubt some other paths we could draw on a piece of paper to get the same effect. What we wanted to say is, look, before we get to the point when we can really say with confidence, this is getting behind us, we can start to maybe bring rates down, we've got to see a lot more evidence. So they will have to stay, policy will have to stay restrictive for a sufficient period of time to get to that point.
But is this a new normal in terms of interest rates?
Oh, the current level?
Yeah, the current level, more or less. Like, will we ever go back to what we had in the last 10 years?
Well, I would be surprised if we go back to near zero interest rates. I think something's going to happen that we currently don't know about. I think if you do all the work that's done on sort of equilibrium rates, where might the rate settle, that would suggest it's lower than it is today as a sustainable rate, but actually nowhere near down to where we were in the sort of the period post the financial crisis. But we're not. That's uncertain, and we're not yet there to the point when we can start reaching, I think, firm views on that.
Well, that was some of our interview with the Bank of England Governor, Andrew Bailey. Now, BlackRock Senior Investment Strategist Laura Cooper is still with us. Laura, when you look at the Bank of England, they kind of have all of the concerns of other banks, plus it's a small open economy, so that gets exacerbated. He's using very similar language to what we heard from the ECB, right? It's like higher for longer. Is it because this is a new phase, or he just wants to change his communication style?
I think it's an element of changing the communication style in the sense that central bankers have now clearly abandoned forward guidance. What struck me yesterday about the Bank of England was there's this common thread among the three major central banks that we've seen over the past week. The first is they are going to be data dependent, which does set up for bouts of volatility around those upcoming event risks. They are suggesting that rates are already in restrictive territory. That's a kind of new language from what we saw before, suggesting they're nearing the end of their tightening cycles. And then interestingly, they're all kind of signaling the fact that the growth deterioration at the margin is starting to feed into their calculus of further policy rates. So that to us does suggest that central banks are really in this environment where it's not so much how high, but really for how long. And that's really where market focus is going to be.
So do you think there's now a general concern that if they over tighten, that then it becomes a policy mistake?
I think it's too soon to tell whether that's the case, because I do think we are in this new macro regime where inflation is going to be elevated. But I think markets perhaps have to get their head around the fact that when they say sufficiently restrictive for a sufficiently long period of time, that could actually mean we're going to see significant deterioration in economic activity, and they're actually going to hold firm at those elevated rates. So markets are pricing in those cuts coming through for the Fed next year. Perhaps that's still a bit premature. So I think that's really the key challenge. And in terms of positioning portfolios, it keeps us cautious on actually tilting further out the U.S. curve, taking that duration exposure because of the uncertainty there.
Laura, the treasuries were on the move, let's say diplomatically, this week. I know there were a number of factors that probably led to that, but is the number one the fact that there's 103 billion in terms of issuance, and we're not quite sure whether the market can absorb that supply?
I think that was a key catalyst this week to send those 10-year yields well above that 4.1% mark. But I think it's less about the level that we're seeing in that rate. It's more about the pace of the moves that we've seen. I think that's why we've seen equity markets react to that renewed rates volatility. Now, going forward, we probably don't expect kind of the magnitude of steepening that we have seen in that curve to persist. If anything, we do expect bouts of flattening mixed with steepening on the back of those economic data prints coming through. But yes, the steepening trade is probably one that is going to be more pronounced over the next 12 months or so. We probably need to see the Fed signal that pause, signal that cuts are, in the pipeline for us to really have strong conviction that that is the place to go. Because when you're getting 5% at the, near the front end of the curve, it's very hard to take that duration exposure.
All right, BOJ. Yes. I like that. I mean, the BOJ surprised twice.
Yes.
Like, do they not? I mean, is the yield curve control now gone? Is it a matter of when, not if?
I think last Friday was a step towards abandoning the yield curve control. I think it's probably too soon for that to kind of take hold right now. Yeah. If anything, we do think that yields are going to drift higher, both in Japan and, but mild implications for the global yield complex. What we're watching for is the currency. We do think the currency has scope for potential further weakness, and that really could be the pressure valve that perhaps prompts the BOJ to actually change that policy because of the inflationary impact. So it's not a Q3 story per se, but it's certainly something that's on our radar.
Great. Thank you so much for joining us. Of course, Laura is the BlackRock Senior Investment Strategist, Laura Cooper, joining us on, everything that happened this week and all of that in like TV time in like 10 minutes. Laura Cooper. Coming up, Crédit Agricole reports a surge in profit for the second quarter. We'll hear from the French lender's Deputy Chief Executive. That's up next, and this is Bloomberg.
We can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
Welcome to Balance of Power.
This is Bloomberg.
M&A transactions in the field of wealth management is not a new strategy, but we conceive these operations, as always, as simply a complement to the capacity of growing organically. And our wealth management business, Indosuez Wealth Management, is growing organically quite significantly, and we thought that this opportunity of acquiring the group Peter Carm would be a nice complement.
Well, that was Jérôme Grivet, the Deputy Chief Executive Officer at Crédit Agricole, on the French lender's wealth management operations. Now let's stay on the European banking story. Joining us now is Bloomberg's Tom Metcalf, who of course oversees all of our banking coverage here in Europe. So lots of news from Crédit Agricole today. Tom, what's the highlight?
Yeah, I think it is that deal. So they're buying that Belgian wealth manager, and you know, clearly there is that strategy to become, you know, much more dominant in that space. And we understand the reason behind that. You know, more recurrent revenue, much more stable. So it's an interesting deal. And then those earnings, as you sort of look a bit further, very, very strong. I think they were described as consensus busting by our analysts. So really strong performance by Credit Ag. Their shares are up. A much more interesting story at Commerzbank, actually, where basically they were communicating about buyback, but I think they've disappointed the market by not having enough detail. And whether that was a sort of a deliberate move, maybe there's some pressure behind the scenes not to do that, or just generally bad comms, is really interesting because you know, most analysts are throwing their hands up in the air.
Yeah, I was going to say, actually, if you look at some of the other continental banks, I mean, it feels like the French are actually in a little bit of a sweet spot. Is that unfair? I mean, they seem to do better than others. Is it because of their positioning or execution?
Yeah, I think that's been the theme. Like BNP, SocGen have all done really well in recent days. You know, yeah, I think it's sort of that happy accident of timing. You know, they're still sort of benefiting from that rate rise boom, and also just being well sort of positioned in their market. Like the French market's relatively strong. But I would also say across the big continental markets, it's been a pretty strong set of earnings, which does sort of contrast slightly with the UK, whereas a bit more sort of we're further along in the rate cycle, and they're sort of starting to see those net interest margins get crimped.
Is there anything that shareholders look at? I mean, apart from valuation, and some of these banks, you don't really know how they'll grow in the next 5 years. But you know, what are some of the questions that shareholders are asking themselves?
Well, I think, you know, first of all, is that question about banking itself, right? You know, you know, the political pressure can sometimes come on. It's obviously very heavily regulated. So that's that big sort of uncertainty looking forward, like what is sort of going to be the kind of political posture towards banks as they make more and more money. But yeah, no, largely it is the interest rate story. It is how much money they can make out of those deposits, and the deposit beta, i.e. how much they can kind of resist giving on to their consumers. And in Germany, they've done a pretty good job of keeping as much of that as possible, which is why you see some pretty good results there as well.
So, really quickly, what are valuations looking like? I mean, I think, you know, about 6 weeks ago you came on and we kind of looked at the numbers, and a lot of U.S. investors think that Europe is a mess. Is that still the case, even for European banks?
Yeah, all the price-to-book values are still, you know, well below 1. Even the best performers, really. You know, I think maybe 1 or 2 of the Nordic banks are above 1, which is, you know, pretty common for many of the big US banks. So no, there's this huge disconnect. And you look at that, it's quite interesting because, as we know, in the US, they actually have higher capital requirements in some areas. So I think it's just a sign of the different views people have on those economies.
All right, Tom, as always, thank you so much for joining us. Tom Metcalf, their head of UK bank coverage. Coming up, Donald Trump pleads not guilty to charges that he conspired to obstruct the 2020 presidential election. So we'll have plenty more on that next. And this is Bloomberg.
deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500. How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
The Treasury's sell-off pauses, but the souring mood in bond markets raises the stakes for today's much-anticipated U.S. jobs data. Amazon's outlook tops estimates on strong e-commerce sales. Apple posts lower than expected quarterly iPhone numbers. And the Bank of England governor tells us it's too soon for the UK to declare victory in the battle against inflation.
It's the last mile, which obviously where policy is really doing the work. And we're going to have to see policy stay restrictive. It's going to have to remain restrictive to have this effect of bringing inflation down, and particularly next year.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, some of the conversations that we're having with Governor Bailey yesterday, of course, concentrated on private sector wage growth, what that meant. They're still expecting that to be at 6%. Those are the Bank of England predictions. And then we just have that breaking news out of British Airways. The Unite union that has been trying to get the workers a higher wage have just announced that they will actually get a 13.1% pay rise. So that's great news for, of course, a lot of the workers, a lot of people that have been struggling with the cost of living crisis. I'm not sure what that does. If you see a big sector move on that, what that does to some of the BOE projections. Now, Donald Trump has pleaded not guilty to charges of conspiring to obstruct the 2020 presidential election. Bloomberg's Kaylee Lyons has the details from Washington.
Former President Donald Trump was arraigned for a third time on a rainy Thursday afternoon here in Washington, D.C., where he pleaded not guilty to 4 criminal counts related to efforts to overturn the results of the 2020 election. Those counts including conspiracy to defraud the U.S. and conspiracy against rights. Now, also at this hearing, the magistrate judge set the date for the next hearing, the first before the judge who will actually oversee this case, Judge Tanya Chutkan. That date is set for August 28th at 10 a.m. Eastern Time. Though the former president will not be required to appear, that is when we understand the judge will actually set the date for Trump's trial in this case. Now, as for what this means for the former president and his ongoing campaign to seek the White House again in 2024, after he left this courthouse and arrived at Reagan Airport, he did briefly speak with reporters and say that this is persecution of a political opponent. And as we have seen in his prior 2 indictments, the charges brought against him have a tendency to actually boost him in the polls. When he was first indicted in the state of New York in that case related to hush money payments paid to porn star Stormy Daniels, his poll numbers went up and he raised hides millions of dollars, and he has also seen his polling go up since he was indicted the first time federally in Florida related to the classified documents case. So we'll wait and see how this affects his campaign, as he is going to face trial dates in the primary season of 2024 and also mounting legal bills as he fights all these different challenges. In Washington, Kaylee Lyons, Bloomberg News.
Well, joining us now to talk about all of this is Thomas Gift. He's director of the Center on U.S. Politics at UCL, University College London. Professor, thank you so much for joining us. When you look at what we've learned over the last 2 to 3 days, I think a lot of people will have questions about the polls. It seems that the Republican Party has not only continued to support Donald Trump, but in some cases doubled down. Is he that popular with the voters?
Well, it's great to see you, Francine. Thanks so much for having me. I think that he is with a section of the electorate, roughly 30 to 40% of Republican voters. You know, I think Trump's primary opponents in particular, though, are really caught in this purgatory because they can either attack Donald Trump at the risk of alienating the GOP base, or they can defend Trump at the risk of just allowing him to cruise to the nomination untouched. There's really no good option. And I think that's why, among other reasons, Trump has such a commanding lead, and we do continue to see increases in the polls for him. You know, every indictment seems to help him and muzzle his Republican rivals. Former New Jersey Governor Chris Chrisley has really been the lone voice arguing that Trump's legal troubles should be disqualifying. But most of the field, they've soft-pedaled the issue, or they've actually defended Donald Trump's witch hunt claims. It will be interesting, I think, as we get closer to the debates, whether any of Trump's competitors pivot and adopt a more punishing stance. But for now, you know, they're seeing the same polling that everyone else sees, that Republican voters overwhelmingly, 70 to 80%, think that most of the charges brought against Trump are politically motivated.
Does it change fundraising and his campaign on that at all?
Well, I think it's kind of a two-edged sword. Certainly it helps him with fundraising. If the last 2 indictments are any indication, he's gotten a really significant surge of money. But at the same time, there are reports that a lot of money is being dwindled from his campaign and being funneled into these legal battles. I mean, they're certainly expensive. They're protracted. He's hiring essentially armies of lawyers. And so that's money that he can't just maintain in his war chest for Iowa, New Hampshire, and the rest of the Republican primaries. But at the same time, given the fact that he has roughly a 30 percentage point lead, I'm not sure if money is really the key issue, at least in the primaries. I mean, that may be a different story in the general election.
So, Thomas, what happens next? I mean, I know there are questions on whether the former president will face jail time, if he can actually run from jail. Is there anything that could happen now that would put voters, you know, off him?
But, you know, I think Donald Trump's tactic is just going to be delay, delay, delay. And in cases like this, prosecution is obviously going to try to move this trial swiftly, but deference really goes to the defendant. So I wouldn't be surprised if it goes really into the heat of the campaign. If Donald Trump would become president, then he could essentially eliminate this court case altogether because, of course, the Justice Department is under his purview. But I really don't see anything changing with Donald Trump, especially if we assume he's going to get the nomination. I think voters have, in large part, made up their minds simply because there's not a whole lot of new information that's being divulged. We already had the second impeachment trial that centered on January 6th. Then there was the House Select Committee, plus everything surrounding the effort to decertify the election results. Voters got to see for themselves on January 6th itself. So that's why I'm just a little bit skeptical that this is really going to move the needle on public opinion.
So, Thomas, if you look at where we are now, do you really think it's Trump against Biden again? And what does Biden have going for him?
Well, I think that Donald Trump is certainly the prohibitive favorite, and it would take something monumental to topple him from his front-runner status. And so I think all the odds suggest that we are going to see a re-election campaign between Biden and Donald Trump. And the remarkable thing about that is that, you know, both are so unpopular that they could actually lose to the other, which is kind of stunning. You know, Biden is, I think it's going to be a referendum essentially on Donald Trump more so than it's going to be on, you know, Joe Biden's presidency. Of course, you know, Democratic voters have been energized by some things that have happened over the last couple of years, like the Dobbs decision on abortion. I think the economy, it kind of cuts both ways. It used to be the case just a few months ago that Bidenomics was kind of a clear net negative, but now we've seen some withering in inflation, and employment continues to be strong, so that's a plus for him. But I think ultimately voters are going to say, do we want Donald Trump in office again? And that's going to be the real question.
Yeah, and how do you think, I mean, what will they ask themselves in terms of questions? Is it the economy, or do they just have an attachment to Donald Trump because he says he's anti-elite? He's different to anyone else the U.S. has ever seen, frankly.
Absolutely. I mean, I think for any other election, we would look to the economy because that's such a good indicator for the success of an incumbent president. But I think what we might be seeing in 2024 is something unique, which is just, do I want Donald Trump in office, given his character, given everything that it has happened up until this point, all the baggage surrounding efforts to overturn the election? There's a certain fraction of the population that is just sort of Trump or else. There's a certain fraction that is never Trump. And so, it's going to be determined by energizing of the base, but particularly probably a small fraction of swing voters, maybe 5 to 6% of the electorate, who are going to, determine the outcome. And that's going to happen in the same number of predictable swing states: Pennsylvania, Wisconsin, Florida, et cetera. And so to some extent, these national polls are telling, but as we know, it's really just these battleground states where the election is determined.
Thomas, do people care about, the Fitch rating, actually? I mean, do they talk about it for a couple of days, maybe in the paper, and then it dies down? Or will they blame President Biden for it?
I'm sorry, I didn't hear your question, Francine.
On the Fitch downgrade, on the downgrade of the U.S. economy, do people care about? Is it something that people will still be talking about come Election Day?
I think probably not. Certainly it's not good news for the White House. An unnamed senior official just described the downgrade as bizarre and baseless. And we had Janet Yellen come out and say that the move was arbitrary. I mean, Fitch is essentially defending their stance by saying that there's been a real deterioration of standards in governance. And I'm not sure that you can lay the blame squarely on the administration simply because it's largely a function of sort of all the dysfunction we've seen in Washington that it was exemplified very openly with the national debt ceiling debate. And that goes to both Democrats and Republicans. I mean, usually it is the case, anything that goes right or that goes wrong, blame or credit is attributed to the White House. But in this case, I think there's plenty of scapegoating to go around on both sides of the partisan aisle.
Thomas Gift, thank you so much for joining us today, director there of the Center on U.S. Politics at UCL. Now, we're also getting some breaking news out of UK for data. July construction PMI actually rising to 51.7. The forecast was 48, so it's better than expected. Anything above 50 indicates, of course, an expansion. Now, Credit Suisse was an icon of the Swiss economy. Its collapse was a huge blow to the national psyche that many thought could trigger a profound change to the way the country works. 4 months on, and Swiss banking is back to making money, and there are few signs anything will change. Oliver Crook reports.
The demise of Credit Suisse ripped through financial markets, and it shook the nation of Switzerland to its very core.
It was no longer possible to restore the necessary confidence, and that a swift and stabilizing solution was absolutely necessary. This solution is the takeover of Credit Suisse by UBS.
UBS intends to downsize Credit Suisse's investment banking business and align it with our conservative risk culture.
Despite outrage, shock, and disappointment, months later, silence has fallen back over the Alps. The question, is this Swiss serenity a sign of stability or of complacency? Switzerland is not known for swift changes. Women, for example, only got the right to vote in 1971. And with a closed-door, government-brokered deal, backstopped by taxpayers, many had hoped that the rescue by UBS would be a catalyst for change. Perhaps the federal elections in October could offer an opportunity for debate, but many feel that moment may have already passed. Another concern, Switzerland is a very small country, but its banking sector underwrites financial risk all across the world. Now, UBS total assets stand at 198% of Swiss GDP. On the surface, all is calm. Unemployment unmoved, inflation the envy of every central bank, and the money in the banking sector, it still flows. But if crisis does arise, does Switzerland have the firepower to meet it?
Well, Bloomberg's Oliver Crook there with a look at the aftermath of Credit Suisse's collapse. You can read more on that in today's Big Take. Just go to NI Big Take Go on your terminal or visit Bloomberg.com. Coming up, 30-year treasuries are heading for their worst week this year, so we'll have plenty of market chat. That's coming up next, and this is Bloomberg. What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, Treasuries pause their sell-off ahead of the highly anticipated U.S. employment data later today. Now, we're joined by Bloomberg's Eddie van der Walt. Eddie has had quite a week. He's been looking at Treasury moves like minute by minute, Eddie, so you probably need to lie down after the U.S. jobs report. How do you look at the Treasury moves? Is it because there's a worry in the markets that they won't be able to absorb the $102 billion of issuance, or is it something deeper?
Yeah, no, it's a confluence of factors, really, right? It's been a little bit of a perfect storm in the Treasury market. We had the Fitch downgrade, then we had this new issuance, and then on the back of that, a lot of people just re-looking at their positions. Now, the long Treasury trade, the long duration trade, has become a little bit extended. A lot of people went that way because they thought that steepening was, coming, but that it was going to, occur not in the way that we're seeing it here, not with the long end rising significantly. And I think, so that's caused a lot of questions for a lot of people who've taken this long exposure. Now, we have seen about 40 basis points of steepening between the 2-year and the 30-year. Of course, back in March, we had an actual deeper steepening. We saw something like 100 basis points on the back of that, the banking crisis, but that was across the curve. This was much more focused on the 30-year, and that makes it worrying. But we're moving towards jobs, and that's going to give us a lot of new data to digest.
So, Eddie, what are you looking most forward to when you look at the U.S. jobs data today, the non-farm payrolls? Again, is it the overall number that gives us an indication, or really is it just wage growth? But also, it's unclear how the market would interpret it. If you have a better than expected figure, it's also because maybe people want to come back to work because they worry about personal finance.
Yeah, absolutely. Just because you're going back to work does not mean the economy is growing gangbusters. It could be that people are worried about their spending and so on, and that they are being forced into that position, which is a very different thing. But the implications for the economy is interesting, right? If you're forcing people back into work, if people do have to come back, if we see the participation rate, in other words, ticking higher, then that means that we're taking pressure off wage growth, right? There's something like if the participation rate's still significantly below where it was pre-pandemic, we can still get about 500,000 workers back into the economy with no pressure on inflation. So the economy is not growing at capacity at the moment. We still have these free workers out there. So they could come back, put downward pressure on wages, and that may just unwind all of these moves that we saw in the steepening moves. That was basically a bet that inflation is going to remain sticky. And we could see that unwind a little bit if we see that feeding back into wages and into CPI next week.
Eddie, is there something else that you're looking out for in the next, I mean, there's CPI next week, but overall, there just seems to be more of an alignment in a lot of these central banks and what they're trying to say, which could be as simple or difficult as, look, rates are going to have to stay higher for longer, and maybe that's a more effective way of dealing with policy rather than actually continuing to hike.
Listen, what we've been hearing more and more from central bankers, of course, is data dependency. Data dependency, we've got to remember, implies volatility, because it implies with every new release, the central bank is no longer giving you forward guidance. It's no longer telling you, hey, we're going to hike rates next time around. So we all know what's going to come. And, you know, we look beyond the next meeting. Now they're saying, hang on a second, we don't know what we're going to do at the next meeting. You've got to look at CPI and reposition. You've got to look at non-farm payrolls and reposition. You've got to look at PMIs beyond that. So every new data release sets us up for volatility ahead of every meeting, because we don't know what the central bankers are going to do. Which data are they depending on? So it's actually a really interesting moment in markets. So I think that's the big one. The other big one, of course, is the oil price moves that we've seen. We've seen the Saudis saying they can extend those cuts. They've said they could perhaps even pump more. So I think that's the other one, because that could just fuel inflation a little bit more at this moment in time where we're seeing it coming off.
Eddie, thank you so much. Bloomberg's M Live, Eddie van der Waal there with the very latest, of course, on all of these markets, treasuries, and yield curves. Coming up, law and order becoming a major battleground ahead of the next general election in the UK. So we'll have the details next, and this is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas and I never thought I would see them in. But I would have hoped it would be better. There's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
The top names in global leadership are on Bloomberg.
We have reformed the whole ecosystem around attracting foreign direct investment.
To get everybody to the table was the most difficult thing. Now we're here. The next is consummation.
The commitment is there. Now what we need to see is the actions.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Welcome back, everyone. Crime fast becoming a major battleground in the UK ahead of the general election as a public trust in the police has fallen sharply. Well, joining us to discuss all of this is Bloomberg's UK government reporter, Emily Ashton. Emily, first of all, congratulations on a really important story that maybe we don't spend enough time on. We'll push it out also on social media. It's called Look, Sunak Says UK Crime is Falling, Britons Are Not Feeling It. And you went to Middlesbrough in northeast England to try and figure out, you know, what the situation was like there.
Yeah, I think what we've realised in Parliament is there is a disconnect between what is said in Westminster and what people are feeling on the ground. So in Westminster, you hear from Rishi Sunak, you hear from the government, police numbers are going up, crime has halved in the last decade. Well, on the ground, I don't know about you, but I hear from friends and acquaintances, well, yeah, something got stolen and the police didn't even bother to show up, or people don't feel like the basics are being done when it comes to the police. So the reason we went to Middlesbrough in northeast England was because that is a crime hotspot of England. The rates of crime are high, particularly serious violence, antisocial behaviour is quite high. So it's just having a look there to see kind of people's experiences on the ground. It's also a really interesting spot politically, because in the Red Wall in North England, that used to be very traditionally Labour. Lots of people turned to the Conservatives after the Brexit referendum, but actually people there now are quite disillusioned with the Conservatives because they're not getting what they want from them in terms of basic services.
And Emily, this is not only for the least affluent communities where this is happening.
No, this is about a fall in trust nationwide. You know, this is about people feeling that if they call the police that they're not going to get the basics done. So I also spoke to somebody in Bournemouth, this lady whose father had his car stolen from his driveway overnight. She called the police, wasn't happy with the response. So actually she took it on herself to post on Facebook, lots of different Facebook groups, that this had happened. She went around petrol stations, shops, and in the end, they tracked it down. The family tracked it down themselves. And she said, you know, if I hadn't done that, we would not have got that car back.
So this is going to be a hot spot, really, for the election.
Yeah, and it already is. You know, the general election is probably next autumn. We're thinking it has to be by January 25. So it's hotting up already. Labour, this week alone, has put out 2 or 3 press releases about crime and how things are deteriorating under the Conservatives. And remember that the Conservatives used to be very strong on law and order. That was their thing. Well, now the polls show that Labour are actually stronger on that. And they think that if they can show that they can tackle crime better than Rishi Sunak, then they've got a real shot at winning the election.
Emily, thank you so much for this really important conversation. Of course, you know, I'd love to get you back on to try and figure out whether this is a cost of living crisis or it's really also just a defunding from what the government has done. Our Bloomberg UK government reporter there, Emily Ashton. Up next, Bloomberg Surveillance Early Edition with Guy Johnson and Kriti Gupta. They'll talk yields. Remember, it's the U.S. non-farm payrolls as well, so they'll have market action, they'll talk about the UK, and they'll talk central banks.
politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Lines.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue. He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg. This is Bloomberg Surveillance Early Edition with Danny Berger and Kriti Gupta.
10 a.m. in London, 5 a.m. in New York, and that means it's 5 p.m. in Hong Kong. Our top stories today. Will today's much-anticipated U.S. jobs data create even more turbulence for treasuries? The stakes are high as the 30-year bond heads for its worst week this year. The number, of course, drops at 8:30 Eastern. Wins and zeros. Big tech becomes binary. Amazon stock surges as e-commerce feels a big beat, while Amazon's top line disappoints again. Plus, crude is heading for its 6th week of gains. OPEC Plus will review oil markets today in the wake of Saudi Arabia's decision to extend output cuts to September. So, welcome to Bloomberg Surveillance, the early edition. I'm Guy Johnson. I'm, of course, stepping in for Danny Berger in London. Kriti Gupta is, though, in New York. Kriti, let's talk about these markets.
Yeah, a little bit of green on the screen, Guy, which is interesting because, one, it's a Friday, two, it's been quite the week for a lot to digest. You would think that maybe everyone would cash out, reset, and you're seeing the exact opposite this morning. Futures higher by about 0.4%, perhaps following the sentiment you saw in Asia overnight. NASDAQ 100 futures outperforming, though, and I think that's the real takeaway because, of course, you did have those Apple and Amazon earnings after the bell yesterday. 2 different stories, 2 different results, and yet you are still seeing green on the screen when it comes to the NASDAQ 100 higher by 0.5%. Guy, we're going to dive into those stories and really what sticks out. I have a lot of thoughts in just a few minutes, but again, the bond market also crucial. You mentioned that payrolls data that we are waiting for in just a few hours. Well, that's going to have a real read-through in terms of the bond market. Is the Federal Reserve's monetary policy regime, the idea that they might pause again in the near future, going to really be the success story they think it is if you start to see another hot labor print? That's going to be top of mind, especially for the 2-year yield, which is already higher by about 4 basis points. So a little bit of bond volatility seeping into the story this morning. 492, we'll call it. 2-year yield is getting closer and closer to that 5% level once again. So technicals playing a role. And Guy, we don't talk a ton about commodities at about 5 a.m. in the morning, but I think it's worth doing. Brent crude at an 85 handle, higher by 0.5%. How much of that is a function of the risk story as opposed to the supply and demand story, perhaps both working in its favor this morning?
You clearly need more Alex Steele on this show. Let me point that one out. The commodity story, I think, is fascinating and will be going forward. Look, there's all kinds of things to talk about in Europe this morning. It's actually a fairly exciting Friday as we build you up to that payroll number. Stock 600, the technicians are getting excited at these levels. Remember, we've come down. We were testing the support on the upside, the resistance on the upside. Now we're testing support on the downside. 458, we're up by 0.2%. There's a lot of single stocks out there that are worth focusing on. But before we get to them, let me just point out as well, we've had a big number out of Germany this morning that is just kind of adding a little bit into the story we're watching in the bond market right now. German factory orders come through, highest level in 3 years, plus 7%. The French number, not so good, but this German number is really interesting, though it does fly in the face of the PMI data we're watching at the moment. And then we come to the single stocks. So let's talk about what is happening here. Wire and plastic products, WPP, the ad giants. Why am I pulling this one out? Because it ties into our next story. They've reduced their guidance for the full year. The stock is down by 7% at the ad giant. The reason for it, they are seeing lower spending from big tech, which I think is fascinating, Kriti, in the light of what we've had overnight from Apple and from Amazon.
Yeah, the business investment story isn't getting as much attention as perhaps it should, as we talk a lot about the consumer stateside. And a lot of that, to your point, Guy, folds into the stories you got from Apple and Amazon last night. Diverging reports from two of the largest tech companies in the world. The iPhone maker facing its longest sales slowdown in decades, while Amazon giving a positive outlook on strong e-commerce sales. Amazon CEO Andy Jassy spoke on the earnings call yesterday.
You know, I think that the business has grown to be pretty large already. And I still think we only have a fraction of the features that we need. I don't think we're close to being done growing there, and that is a very strong area of focus for our stores team and for our senior leadership team as well.
And of course, at its core, Guy, is the story of e-commerce, but it's also a story of cloud as well. To me, I think what's so interesting about Amazon is that you can interpret it in so many different ways. Don't make me nerd out about their shipping component as well, even their logistics business. But all in all, Amazon has had a really rough go of it in the last couple of years. After that post-COVID surge, comps haven't really worked in their favor yet overnight. They're really impressing.
Jassy is ruthless. He's been at this company for 2 years. He's cut costs massively. You can see that. I think costs have only gone up by 7.5%. They were going up by 30%. He's been ruthless. He's cut projects. That is now starting to shine through as well. The stabilization in the cloud business, I think, is really interesting as well. That's worth taking into the rest of the tech landscape as well. But this is a company that had to perform in so many ways. You look at what has happened with Amazon and Apple. You see multiple expansion this year. You need the earnings now to back that up. You got it with Amazon, didn't necessarily get it with Apple.
Yeah, and the Apple story is fascinating as well because, of course, they talked about currency strength and that this weakness in the market, again, they really tried to talk it down, but it really didn't assuage a lot of those investors down, about 1.7%. We're going to get more on that later in the show. Matt Bloxham from Bloomberg Intelligence joins us. And, of course, Sky, we didn't even talk about the bond market impact on all of this. We are getting non-farm payrolls seen rising about 200,000 this morning. The U.S. jobs data that coming off about 8:30 a.m. in the morning. And, look, this is less than the 209,000 increase in June. That's going to have a read-through onto the bond market, which again is going to have a read-through into the ripple effects for tech as well. Bloomberg's Valerie Teitel joins us now for more on what to expect. Valerie, this feels like a little bit of a game changer to kind of cap off a week that's been a lot of volatility, macro and micro.
What a crazy week for the Treasury market, especially this steepening move has really caught many off guard. Will it be sustained by possibly a hot NFP print? We're expecting 200K for the big number today. That's going to be the lowest we've seen since December 2021. Funny enough that at this point in the cycle, 200K is seen as a moderating print. We also get average hourly earnings expecting to moderate down to 4.2 on a year-on-year basis. That's going to be a new low if we do get it, a new low for this past year. So keep an eye on the earnings estimate. But really, Kriti, it feels like the market is going to be quite hesitant to trade this number. There has been probably just a lot of positioning washout this week, maybe a little just less desire to put some big trades on. It is August. Remember, everyone is looking forward to those holidays. And this is just not this isn't the last NFP print before the Fed meets again. Remember, we get 2 NFPs and 2 CPIs before the Fed convenes in September.
Do I care about this number or do I care about CPI next week? Do I care about the auctions next week? Is this just a holding story today? Do I really care about that CPI number next week? Because that could really upset the apple cart.
Look, I think the market is going to have a less tendency to react strongly to this because we do have one more coming before the Fed meets again. But that being said, Guy, the market is very skittish. This long end move has caught so many off guard, this steepening that you normally don't see at this part of the cycle. And it's especially rare to see this kind of move anyway, this bear steepening that we have seen with 10s and 30s hitting new highs since September. It's going to be an interesting print today. I do want to look forward to the refunding announcement, refunding next week. We have $100 billion issuance next week, 3s, 10s, and 30s hitting the market.
And I think it's those kinds of numbers that are beginning to freak everybody out. It's the scale, particularly the duration that's coming to the market that I think is beginning to really freak this market. Valerie, great stuff. Thank you very much indeed. We'll look forward to that number. It drops at 8:30 Eastern. Some great coverage coming up from the surveillance team. Let's talk about what the earnings picture looks like as well, because this kind of macro story folds in to what we've just been talking about as well. So we get another earnings beat coming from A.P. Møller-Mærsk. However, this comes amid a slowdown in shipping demands. The pandemic was all about goods. This company was roaring. Now it's slowing down. The company lowering its outlook for the global container trade. It moves around a sixth of global containers around the world, adding that there is no major signs that volumes will recover this year. This is what the Maersk CEO had to tell us a little earlier.
Our case is not for a recession, but it is for a really subdued environment that will continue for the rest of this year, and something that we will have to review a little bit when it comes to our expectations for 2024, but certainly not a strong rebound.
The Maersk CEO, in some ways confirming what we already kind of knew. We saw this huge boom in goods during the pandemic. That has now shifted to services. Maersk is probably one of the victims of that, one of the most obvious victims of that. Bloomberg's Copenhagen bureau chief, Christian Weimer, joining us now. Christian, you just came from the earnings call, the press call. What do we learn? Tell us about what came out of that call. What are they telling us about the macro picture particularly? They're such a good company to tell us how the global economy is doing.
Yes, if I'd highlight two things, then one thing is the macroeconomic slowdown, as we all know, is happening, and Maersk is better positioned than most other companies because they operate in almost every country around the world. The other thing is the destocking that's going on in the global economy right now. During the pandemic and also in the immediate aftermath, companies were filling up their warehouses with consumer goods, partially in response to the supply chain problems that they had faced. Now they're emptying these stocks, and that means that they're not ordering new consumer goods in Asia for their customers in Europe and the US, and therefore they're also not transporting them. And that's bad news for a company like Maersk, which transport goods, but also bad news for some of the producers.
And Christian, to your point, you're seeing that narrative essentially kind of ripple through the likes of UPS, FedEx, even DHL, really talking about that they're having to kind of cost cut or lay off people as a way to deal with that challenging environment. What is Maersk's solution to that?
Yes, I would say that the good news for Maersk is that they were well prepared for this. They knew that this would happen, and they had flagged that also previously. What they've done is that they last year, they tied a lot of their customers into long-term contracts. That capped the profits a little bit last year, but now they're getting the benefits from that. The other thing is, as you mentioned, the cost cuts. And Maersk already started looking at cost cuts before the boom period ended because they knew this was happening. They haven't, however, announced large job cuts, but we'll see what happens.
Hey, Christian, thanks for jumping off the call and coming to talk to us. We really appreciate that. Christian Weinberg, Copenhagen bureau chief here at Bloomberg. Thank you. Okay, what do we got coming up for you? We need to talk about what is happening in the crude market. Oil heading for its longest weekly winning streak in more than a year. It is 6 weeks up. We'll have more on that story. We're going to get more on the job story as well ahead of the payroll number. Sarah Hewen, head of Europe and America's research at Standard Chartered, is going to join us later this hour. Plus, our special coverage from the Aspen Economic Strategy Group continues today. Wall Street Week host David Weston is live on location, talking to a bunch of policymakers and executives, including Fed President Austin Goolsbee. Looking forward to that later. This is Bloomberg.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
It's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do.
Making M&A transactions in the field of wealth management is not a new strategy, but we conceive these operations, as always, as simply a complement to the capacity of growing organically. And our wealth management business, Indosuez Wealth Management, is growing organically quite significantly, and we thought that this opportunity of acquiring the group Peter Carm would be a nice complement.
Wealth management seems to be where it's at. Jerome Grivet, the Deputy CEO of Credit Agricole, speaking exclusively to Bloomberg, talking about the bank's quarterly results and that acquisition, that stake acquisition of the Degroof Petercam in the wealth business. Leo Kane joining us now. Leo Kane Sherpa joining us now. Leo, there's a lot to take away out of this. You've got the numbers to deal with, what's happening in the underlying business, plus you've got this wealth management acquisition as well. Walk me through what really stood out.
Yes, exactly. It was a bit of fireworks this morning. I didn't expect that many news from Crédit Agricole this morning, to be honest. Yeah. But the highlight was definitely this wealth deal for Degroof Petercam, because it really shows how lenders are trying to gain scale in the wealth space. Yeah. It's a no-brainer for them, really, because it provides them with stable fees, more stable fees, and just makes them less dependent on interest rates.
How does that compare then with the Continental story? I mean, when you compare this to the likes of Deutsche Bank, et cetera, what are we seeing?
Yes, exactly. So Deutsche Bank was definitely among the highlights again this earnings season. Their fixed income trading was quite resilient, better than some Wall Street peers, which is always quite key for Deutsche Bank. But their share buybacks have sort of underwhelmed a little bit, and shares have actually taken a hit since results came out last week. And we've seen the same with Commerzbank this morning, actually. Shares were slightly down because they didn't give a firm announcement on buybacks, didn't give clear guidance on buybacks for the second half. So that's one theme for European banks this season.
We're going to get a strategy announcement from them coming up, so I do wonder whether that's why we have the caution from Commerzbank maybe on that. Look, I thought Commerzbank was interesting in as much as they're talking about the tailwind that is still coming from higher rates. That's net interest income. That story is still positive for Commerzbank. It's interesting to hear what UK lenders are talking about because they're being much more cautious. Is that the canary in the coal mine?
Exactly. So when you keep in mind that the BOE has started raising rates much earlier than the ECB, more than 6 months earlier, I think that it's fair to assume that there's going to be some downgrades in expectations for European lenders as well. So that's definitely something to watch for the second half.
Great to see you, Leo. Thanks for stopping by. Really appreciate it. Leo Kane Sherpa. I got it all in this time. Thank you very much indeed. What are we going to talk about next? Let's talk about the oil market. Crude is on its way to its sixth straight weekly gain. OPEC Plus extending production cuts, Saudi sounding pretty hawkish. We'll talk more about that next. This is Bloomberg.
decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple of people, our average restaurant now does about over $1 million per restaurant in digital sales.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Tonight, Wall Street Week comes to you from Colorado. Join David Weston for the 2023 Aspen Economic Strategy Group meeting. Special guests Cecilia Rouse, Raphael Bostic, Brian Moynihan, David Cody, Austin Goolsby, and Larry Summers join David Weston for exclusive conversations on persistent inflation, rising debt, and demographic challenges in the U.S. and around the world. It's a Wall Street Week you won't want to miss. Tonight at 6 p.m. Eastern with replays all weekend. The Fed is hoping for slowing job growth, but too much could spell trouble.
There is no way that many people would have predicted the kind of data that we witnessed.
Things have slowed down, but they're not falling off a cliff.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
Which nominal wage growth does the Fed need to see?
At what point do people start to say, this is not sustainable?
Maybe this will be the turning point.
The July Jobs Report, today on Bloomberg Television and Radio.
So this is Bloomberg Surveillance. This is the early edition. I'm Guy Johnson in London, in for Danny Berger. Crudy Gupta, of course, is still in New York. Let's talk crude, Crudy, and figure out what is happening here. Because the oil market is up again. Longest winning streak since all the way back in June last year. I think we're up 6 weeks now if we finish higher today. Later today, OPEC Plus will review the market. This, of course, in the wake of Saudi and Russia's decision to prolong output cuts. A little bit of a warning in there from Saudi as well, that potentially we could see further cuts coming through. There is much to discuss, because this, again, folds into the macro story and folds into this inflation narrative the bond market's freaking out about. So let's bring in Bloomberg Senior Executive Editor for Energy and Commodities, Will Kennedy. Will, the last 6 weeks, the floor is in, it seems. The cuts are working. There is a higher floor now being set. What does that tell us about, though, where we go from here? I was talking to Pioneer earlier on this week. They're talking about $100 by the end of the year. Is that now looking likely?
I think most people would hesitate to say that looks likely. I think it's clearly possible. I think you're right that we've had a change in the oil market narrative over the last 6 weeks, and in the early part of the summer, people were feeling quite bearish, and that was mostly a macro-driven trade. And the Saudi policy in particular has succeeded in turning that around. And importantly, demand has remained very, very robust. We heard from the BP CEO earlier this week, who said that demand has been incredibly robust, that we're going to add 2 million barrels a day this year, and he expects demand to grow more strongly next year. So I think that's what surprised a lot of people, in that in the first part of the year, people were gloomy about the macro outlook, what that might mean for oil demand. And those fears, frankly, have not materialized. Demand around the world, for now at least, looks fairly strong. And we put that together with the Saudis' decisions that are tightening supply, and that's what's underpinning this rally.
Well, Will, to talk to us then about the extent of that demand really being a gauge for the world's economic story. Look, I think the consensus here is around the world, I should say, is that the recession we were planning for might be farther away than we thought. The momentum that a lot of consumers are showing. But if you are seeing the market kind of guided by these cuts, to what extent is the oil market or is trading oil still a statement on the macroeconomic picture as opposed to a statement on the Saudis?
Well, you've always got to consider it from both parts. I mean, if we take supply first very quickly, I think supply was very ample in the first part of the year, and perhaps more than people were expecting. We saw a lot of oil from Iran. We saw oil from Venezuela. Russia wasn't really cutting production as much as some people expected, although there's been a little bit of a change there as well. And then Saudis came in, and we agreed some cuts among OPEC members, and then came on with this big voluntary cut, which has really obviously turned the balance. When we go to the demand side, demand has been more robust than everyone was expected, and that's clearly true. So what we've got now is a tightening supply situation and a robust demand situation, and that's why we've seen this 6-week rally. There is one caveat quickly, though, which is that people are a little uncertain about the outlook in China for demand. I mean, there are some ideas that we may see some weakening in demand there, and clearly the numbers have not been great out of China economically.
Yeah, that's a critical factor. Can I just take it back to what is happening in the US and to a certain extent in Europe as well, though? Gasoline prices in the States have risen really quite sharply recently. Yeah. Is that trend going to continue? Because that has a massive impact on consumer expectations around inflation. What's happening with diesel as well? Diesel seems to be really interesting right now, because again, that's quite a big tell on what's happening with the economy too.
Yeah, I mean, gasoline is strong around the world. There are several factors driving that. I think in the US that, people are commuting more, and that means in the US, people drive to work, and that's clearly driving some very strong gasoline demand numbers. In Europe, there seems to be this trend that people are turning their back on diesel cars and going back to EVs to some extent, but also to gasoline demand, and I think that accounts for some of the stronger gasoline numbers we've seen in Europe. And then on the diesel side, diesel is a more industrial story, and it's not perhaps quite as exciting as gasoline, but despite some of the weakness that we see in the industry in Europe, the recovery remains fairly strong in the US, and there isn't quite the amount of weakness that people were expecting. So, yes, gasoline is very strong, and I do think that could become an important economic story going into the winter, because if you look at gasoline prices, come September, we may be looking at year-on-year gains in gasoline prices.
And that's going to show up in the inflation numbers, and that's going to be a big factor. Will, that's a really important point. Will Kennedy, thank you very much indeed. Coming up, Sarah Hewen's going to be joining us from Standard Chartered. We're going to talk about the payroll number. That's next. This is Bloomberg.
Middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are, launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yangwang yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Today's much anticipated U.S. jobs data could create even more turbulence for treasuries. The stakes, they are high as 30-year bonds head for their worst week this year ahead of a wave of issuance. And it's a tale of two tech giants. Amazon rallies on a positive outlook fueled by its e-commerce business. Apple, on the other hand, slipping on disappointing iPhone sales. Plus, crude climbs. OPEC Plus due to review oil markets today in the wake of Saudi Arabia's decision to extend its output cut to September. We're going to go drive all the market moves. I'm Kriti Gupta in New York with Guy Johnson stepping in for Damien Berger in London. Guy, a lot to digest, but it really feels like you have your eye on the commodity market, perhaps, after all the volatility in the bond market this week.
Look, I think they're all very much the same story, actually, I think, and that's the interesting part of what is happening here. Commodities are rising, particularly gasoline, which I think is really worth paying attention to, which feeds into this narrative about higher inflation. That seems to be maybe what is behind this move we've seen in the bond market this week, this concern that maybe inflation comes back and is more sticky. Equity markets have taken a beating this week. Today, we see a little bit of firmness coming back in, but it's really fascinating. European equities have tested resistance. Now they're testing support. So the stock 600, we're trading at 459. The technicians see this as being quite an interesting level. We're up by 0.2%. There's a lot of single stock news. We'll come to that in just a moment. You've also seen German factory data today. Factory orders coming through, plus 7%. That's the biggest number in 3 years. It feels a little like an anomaly to me. You look at the French number, there's weakness there. You look at the PMI data, there's weakness there. We're going to get more data out of Germany over the next few days as well. But nevertheless, the bond market reacting to that. But it has been a big week for the bond market, driven by the long end. You've had this bear steepening, which is not normally what you would expect. WPP, the ad giant, down by 6.3% today. Why is that interesting, Kriti? It's interesting because what they're talking about as they've cut guidance is a lack of spending coming through from big tech, which I think is fascinating in the light of what we just heard from Amazon and Apple.
Well, speaking of that big tech story, Guy, you're seeing the outperformance here in the States as a reflection of perhaps specifically Amazon, because I don't think the diverging story from Apple is really having that much of an impact. It's interesting to me, though, that even though Apple, this massive company, this $3 trillion company, isn't having a bigger macro effect. Nevertheless, futures higher by about 0.5% stateside, 45-42 for our radio audience on those contracts. But again, like I said, the outperformance is in the tech sector. NASDAQ 100 futures higher by about 0.7%. We're going to dive into that diverging story in just a few minutes with Matt Bloxham of Bloomberg Intelligence. He's going to tell us the similarities and the differences between the Amazon story and the Apple story. It's one you don't want to miss. But of course, even the tech story is going to be subject to what's going on in the bond market. And the two-year yield really comes into focus there because already you are seeing a 4 basis point move higher this morning, 492 on the front end of the curve. And look, you have a wave of issuance next week. So there is going to be volatility priced in terms of digesting some of that. But you also have that payrolls data in just a couple of hours, CPI on Tuesday as well. So a lot for the bond market to digest if we get another hot payrolls report. Do we see that two-year yield penetrate the 5% level? That's going to be crucial. And of course, Guy, Brent crude, your favorite, an 85 handle on that commodity.
Alex Steele's favorite, not my favorite. Clearly rubbing off, though, which I'm not sure is a good thing.
Influence.
Do you see her in the... She clearly has. You see her in the cowboy hat yesterday, looked great. I think the bond market's doesn't have things to digest. I think it's just got indigestion at the moment. I think that is one of the key factors that we've had to really think about this week, and that big move we've seen at the long end. Today's payroll number is certainly going to be fed into that narrative. So it comes out at 8:30 Eastern, of course. Non-farm payroll seen rising 200,000 in July. Remember, that's still a strong number, slightly less than the 209 increase in June, but I think we're going to see a lot of revisions. Sarah Hewen, Standard Chartered Head of Europe and Americas Research, joins us now on set. Very nice to see you.
Nice to see you too.
What are you anticipating?
We think we'll be below 200,000. I mean, we had a weaker than expected number for June, and we think that we're seeing a normalization of the labor market in the US at the moment. So we think we could see a 170 handle. Obviously, that's weaker than the consensus. It's weaker than the whisper number, which actually has nudged up over the course of the past few days. I think, it's going to be an interesting report. For us, the focus is average hourly earnings, what's happening to wage growth.
And what do you see there? Because there's a whole bunch of things below the surface that are always worth watching out for. Participation's always interesting. What's happening with hours worked, and as you say, what is happening with wages? Pull that all together for me.
Yes, I mean, hours worked have been fading over the last few reports, and I think that that's also indicative of a normalization of the employment situation. Participation, it's risen, but it's still not where it was before the pandemic. So you still particularly have older workers who are still outside the workforce. So they're part of the labour demand-supply imbalance that Powell likes to talk about so much. In terms of average hourly earnings, I think it is worth watching, because year on year, we haven't really seen a further downtrend. Compared to last year, obviously, there's an improvement, but for the first 6 months of this year, it sort of ranged between 4.3%, 4.4% year on year. And actually, since February, if we look at the monthly data, those have been nudging up month by month. So I think it is a bit of a warning sign. It's obviously what Powell was looking at in previously, the concern that that was going to be driving underlying inflation higher. Our own view this month is that we see it nudging back to 0.3%, so that's broadly on consensus.
Sarah, what has more weight, though? For example, if you see a weaker payrolls number but a stronger wage growth number, does that interpreted still as hawkish, or is that a victory on the jobs market?
It's a bit of both. I think that market would be somewhat cautious if we do see earnings growth rising again, even if we do see payrolls dropping. Having said that, the payrolls numbers really for the last couple of years have exceeded expectations. So a second consecutive month of lower than expected payrolls growth, I think, would be regarded as quite significant, and suggesting that we are seeing a slowdown in the payrolls numbers and the slowdown in the labour market overall. We've got unemployment, of course, as well, and that's a bit of a wild card. It'll be influenced by what's happening at the household survey employment numbers. We think that it'll level out around 3.6%, which again historically is still very low. If we look at all these numbers compared to the pre-pandemic period, then it's difficult to say that the jobs market is anything but buoyant.
Sarah, right now we are getting a lot of headlines from the labor movement in the United States and arguably around the world as well. Guy knows that I've been following it very closely. Overnight, we got news and reports that the United Auto Workers, which is dealing with some of the automakers here in the States, asking for a 40% pay hike. Talk to us about the stickiness of those wages. Is that something you're interpreting or factoring in to your models when it comes to kind of how strong the labor market still will be?
It certainly is. Of course, we've had some good news in terms of employment costs, unit labour costs, so what's happening to productivity is very important as well. And the second quarter data there were encouraging. It suggested that labour cost pressures are easing. That should allow inflation to continue to trend lower. But at the same time, when you still have very high vacancy levels, then wage demands are likely to be higher. What's interesting to us is that we haven't seen, with payrolls numbers so strong, that we haven't seen stronger wage growth. We do query whether the payrolls numbers are telling the real story. We think that they may be overestimating how strong the labour market is in the US at the moment.
Well, if you do start to see that weakness in the labor market materialize, as you point out and as you are forecasting, at least for this report, is AI, for example, a way to fill that gap?
We think it certainly is. We've done a lot of work on this. The productivity improvements, the productivity gains from AI are going to be significant in the coming years, and that should be good overall for growth. Of course, it is risky for some sectors of the labour force, and we're expecting to see more tensions emerge as a result of that. But overall, AI productivity should underpin stronger trend growth across the world, particularly in developed markets.
Sarah, can I get your take on what happened yesterday over the road at the Bank of England? We're in restricted territory now. Does that mean the Bank of England's done?
Nearly done, nearly done. I mean, we think that we'll probably see a hike at the next meeting in September, possibly November. What's interesting is that I think yesterday's press conference raised a question mark over whether you would go all the way through to November. Yeah. Our own view is that we see 575 as the peak in rates, and market seems to have adjusted expectations down to 575. So data dependency, of course, that's the mantra for all central bankers now, but particularly for the Bank of England. What happens to inflation? What's happening to wage growth? You've got both moving in somewhat sort of different directions at the moment, but wages do need to slow if we are going to see inflation enduring at the 2% target.
Yeah, a lot to digest there. And of course, cable, as we speak, at about 127, the strength in the pound, both a positive and a negative. Standard Charter's Sarah Hewen, we thank you as always. Coming up, we go to the micro. Apple and Amazon wrapping up big tech earnings with mixed results. More on that next. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Three prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
There
results reflect the fact that the environment is challenging. Consumers face pressure from general interest rates, higher inflation, and so there are a lot of cross currents that Apple, like all other companies, cannot outrun.
Daniel Flack, Senior Research Analyst from Neuberger Berman, speaking about Apple's results, which came out last night. The iPhone maker posting a third straight quarter of declining sales, predicting a fourth. Amazon, though, generating strong revenue in its core sort of e-commerce business. It's dropping down to the bottom line. That's the critical bit with Amazon, because that hasn't really happened before. Matt Bloxham of Bloomberg Intelligence joins us now. Let's start with Apple. Massive multiple expansion recently. Yeah. Stocks had, I think going into the number, it's up 47%. Is there any good news? Is there enough good news? Is there some good news in there to justify that multiple expansion? Because I'm looking at the stock this morning and I'm questioning it.
Yeah, I mean, there's definitely some good news in there. Whether it's enough, we'll have to wait and see. And I think the good news, particularly around switching. So they said that the June quarter was their record quarter for switches into the iPhone ecosystem from Android, and they expect that to continue. And I guess linked to that, China was a bright spot for them in the quarter, and they said switching in particular is a big opportunity for them in China. And then on top of that, you've got India, where historically been a very Android market, and they've been doing a lot of investment into the Indian market recently. So with a broader lineup with some cheaper handsets, maybe India's another growth opportunity for them. So if you're bull on Apple, I think it's those things you're clinging to that can make you feel comfortable that this kind of growth headwind is going to reverse maybe over the next year or two.
I think I must give you another question.
I was waiting for you to step in. Apologies. Matt, talk to us a little bit about kind of the dollar strength story, especially when it comes in line with services idea. I think what's so interesting is that Apple specifically said there is that strength in China. When you look at some of the tech peers, and everyone is saying it's weaker there. Why is Apple standing out in China?
Well, I think it's because there's still this kind of aspirational consumer there that, it's historically been a very Android-dominated market, but, with a kind of broader lineup of phones and with greater investment focus there, there is still a big opportunity for them to encourage people who've got more money in their pockets to switch from cheaper Android-based devices into the Apple ecosystem. Now, obviously, some of those Android devices, particularly the kind of local Chinese brands, do have kind of technology innovation ahead of Apple. So as they kind of catch up, and we'll have to see what the iPhone 15 has to offer, that might be another catalyst for them to kind of continue with that switching and gain share, essentially, in China.
Well, another piece of the Apple story that I think really relates to the Amazon story is simply this massive divergence in goods versus services. The goods part came down pretty significantly, but their services revenue, a real standout. Matt, if you apply the same logic to Amazon, shouldn't you see that weakness in e-commerce and shopping there as well?
Do you mean in terms of Apple or
in terms of Amazon? But if you're seeing this broader pullback in goods consumption, why is Amazon the standout?
Well, I think, there's definitely kind of a switch to own brands, but, I think Amazon's retail, online retail is such a kind of broad universe that there's an opportunity there for consumers. And I think a lot of consumers, their first thought is I need to kind of downshift what I'm spending. Where do I go? I go and look at Amazon. So I think they see that as an opportunity, and they saw 4% growth in retail, which is one of their strongest performances for a while. And I think, they continue to see that optimism. It was cautious optimism, but I think they are a good they're a good platform for people who are shifting to spend on better value products.
Is Amazon just a different company now? It used to be a company for years and years and years, massive top line. That top line then gets eaten in the middle because of all the spending they're doing, which was huge, and then there was no bottom line.
Yeah, that's right.
But that's different now.
Exactly, and I think particularly on the kind of online retail where, they spent dollars and dollars and dollars on the retail fulfillment, and that, I think they kind of got a bit carried away with that. Andy Jassy has been really kind of reining that in. They're moving to this regional model for their fulfillment services. That's delivering real margin benefit for them, and they expect that to continue. So it's been a lot of hard work, but with headcount reductions, a reorganization of how they do this fulfillment, that's definitely giving them a lot of payback. We saw that operating margin was 60% above consensus expectations of the quarter, so it was a big.
And how much more is there still to come on on that front?
Good question, but I think there's still more to come here. They're kind of their forward quarter guidance on operating margin ahead of where the market is, and they certainly were giving optimistic commentary that as they continue with that regionalisation strategy, you're going to see more benefit. Also, on top of that, the Amazon Web Services business is hugely profitable. It's 16-70% of sales, but it's almost 100% of the profit, and that's continuing to grow in a double-digit momentum. So there's still operating margin potential for them in the cloud business too.
It's going to be interesting to see how these stocks open. We've got a fairly good early indication, very different narrative on the stock market performance. Matt, as ever, fantastic. Thank you very much indeed. Matt Bloxham of Bloomberg Intelligence. Kritik?
Yeah, a lot to digest there. I'm curious about his logistics business. We gotta go through all of that in just a few minutes. Coming up on the show, of course, a look at some of the market-moving events you're going to watch throughout the day. We've got the macro and the micro covered. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
That's sort of an unemployment with slowdown, which is really what's going on, and we could talk more about it, but that's what's really going on is people are employed, they have money, they're spending money, and the Fed is trying to slow down the economy, and it looks like we're reaching a pretty good equilibrium.
That's, of course, Bank of America CEO Brian Moynihan speaking yesterday at the Aspen Economic Strategy Group to David Weston. Special coverage continues from that meeting. Today, we've got some fantastic interviews coming up. Atlanta Fed President Raphael Bostic, Austin Goolsbee will be joining us as well. Looking forward to both of those two conversations with David a little bit later, particularly in light of what we've got with payrolls coming up. Let's talk about what else we've got coming up today. Nicola earnings coming up ahead of the US market open, 7:15 Eastern time, of course. We're going to hear from BOE Chief Economist Hugh Pill. He's going to be briefing as well the agents around the UK. We've got key OPEC members scheduled to review the oil market and an online monitoring meeting at 8 a.m. Eastern. That, of course, after we see Saudi and Russia continuing the cuts. And then, of course, the main event.
Yeah.
Jobs Day in America. Jobs Day in the USA. The latest report out at 8:30 Eastern, Pretty.
It's got a good rhyme to it, I think. When we have every Friday, or every first Friday of the month, I should say. That's the macro story, Guy, but of course it's going to impact everything that's going on in the micro, which brings me to some of the stocks we're watching in the pre-market this morning. We got to hit those Apple and Amazon stories, because again, a tale of two tech giants. Apple dropping, we of course talked about this, the slowing iPhone demand, not really making that kind of progress, also not seeing really a light at the end of the tunnel, potentially seeing that weight lead into the next quarter as well. And Amazon, a completely different story, higher by 9%. Guy, it feels like it's about time that Amazon kind of came back a little bit. It's really been the underperformer of a lot of its tech peers.
Absolutely. And actually, I think we've been waiting even longer than that. As I keep saying, Apple used to be a company with great top line but terrible bottom line. Now it's got both. And that is a huge shift for this company. Jassy's made a massive difference.
He really has, and I think when you come to kind of the AWS versus e-commerce space, you also have to factor in the fact that Amazon has a massive logistics business as well. It's the reason they can do things like Prime subscriptions or two-day delivery, and even that part of the business is really struggling. So of course, we're going to keep an eye on that as well. A couple of other stocks to keep an eye on, Guy. Cybersecurity firm Fortinet also down this morning, and leading, by the way, the entire cybersecurity complex down lower as well. They're basically saying deal delays are the issue here, down about 18%. It's a story of a lot of demand, not a lot of capacity, which really puts pressure on the stock as well. But to the other side, you have the likes of DraftKings. Gambling, sports gambling, very much in focus. I think on the European side, you're seeing a lot of those European stocks higher as well, leading, or I should say taking DraftKings lead, higher by about 14%.
So Entain is up. I'm just looking at Flutter right now. These are two big companies that in some ways compete with DraftKings, and therefore the overlap is quite significant. So Flutter's up by 2.83% today. Entain is up on the back of these numbers as well. So that story is certainly translating across to this side of the Atlantic.
Yeah, it's an interesting one. These are global stories. I mean, look at the trends that are really kind of making their way through in the sports betting complex, but also in the cybersecurity complex, as we talked about as well. Guy, I want to throw one last one at you. Coinbase this morning, those shares moving as well. Their quarterly revenue topping those estimates. It is higher this morning by about 1.3%. They're saying, look, that transaction revenue, it came a little bit under pressure, but we are still seeing volumes higher. And the impact here is that all of those crypto stocks, all of the miners, all of even Robinhood, which has about 60% of its exposure to crypto, higher following Coinbase's lead.
It's interesting, though, as well. You take a look at what is happening with Bitcoin. There's a bit of caution around that at the moment from a technical point of view. What has driven the rally, how much liquidity there really is in that space at the moment. I don't know. You talk to people in the space, the message I get, they are clearly sort of optimists, but there's a little bit of caution there as well.
Yeah, I think what's interesting with that is Coinbase specifically addressed that first half gain in Bitcoin really did help underpin it, but they also gave a little bit of word of caution that might not sustain. Nevertheless, it looks like investors looking through a little bit of that warning. Guy, this morning, a lot of micro to digest, but it's really the main event of the morning. That payrolls data coming up at 8:30 a.m. New York time. I believe 200,000 is the expectation, which you made earlier was the point. It's actually a lot relative to what we've heard in the past.
Where we are in the cycle, it's an awful lot. And I think it's going to be fascinating. Take a look at what happens with revisions. I think that's going to be really interesting as well. Take a look at what is happening with some of the underlying data. Participation is going to be really important. Wages are going to be really important. Hours worked, really important as well.
Yeah, a lot to digest. Of course, the surveillance crew is going to take you to it. That does it for early edition. Surveillance is ahead. Tom, John, and Lisa with an all-star lineup. Stick with us. This is Bloomberg.
with sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting and then be the one who says where that data goes.
It's just not a surprise that we're pulling back here.
There are signs of weakness in the economy coming through.
Investors are stepping back and saying, we're going to wait to see how far yields rise.
What you want to see is inflation slow credibly and sustainably.
Until the recession does materialize, we can expect high rates for a period of time.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is Payrolls Friday, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market on the S&P 500 firmer here by 1/3 of 1%. That jobs number, 2 hours, 30 minutes away. The estimate at the moment, 200K. TK, welcome back. Back especially for payrolls.
I've got the plague that's across the nation. Frankly, it's worldwide. And, I'm healthy. I'm ready to go. It's jobs day.
That's good to know.
Have my Wheaties.
Your Wheaties?
Wheaties, you know what Wheaties are?
Is that a cereal?
That's a cereal.
Okay.
It's like you have your wheat in your childhood.
We would have Weetabix.
You had your Wheaties and you'd get better. At least they had Fruit Loops, but that's...
So much sugar in Fruit Loops.
Lucky Charms.
We'll talk about that
Remember
another time.
Lucky Charms? I remember the first day
Lucky
of Lucky
Charms are a problem.
My sisters had it.
Had them every
They should come with a health warning.
Yeah.
They should.
They really should.
You might turn out like me.
Let's talk about two single names first of all, Amazon and Apple. Apple just about meeting expectations after the close yesterday. The stock trading a little bit lower. Amazon is higher by 9% in the pre-market. Beating a raise from Amazon. Price targets hiked at Morgan Stanley, Piper Sandler, Citi, Evercore, Tom, taking their price target from 150 to 190. We trade at 140 in the pre-market.
Amazon, with all the pandemic and all the second guessing about there's a national crisis, we deliver the cardboard boxes, we have to dive in and do what we need to do. They did. They overdid it. Bezos went off to run the Washington Post, and the new guy came in, and the new guy, this is the first real glimpse of post-COVID Amazon. It's a good number.
Jassy getting it done. Lisa, Evercore calling this quarter an unlock for the stock, as if the stock needed it, given the double-digit gains year to date we've had so far.
I do love that. It's sort of where we're coming from, and then you post another almost 10% gain on top of that. What are we looking at here? And that's the reason why it's really bolstering the overall index returns, even though Apple is a bit more soggy and is losing its $3 trillion moniker. But I'm looking right now at this idea that they cut 27,000 people under Andy Jassy's tenure, as well as increasing some of their revenues. And this, I think, is what's getting people excited.
I agree with that. And it's not just COVID. There's some new, maybe not frugality, but maybe adultness there that we're seeing out of these big tech companies. I don't want to go into it now, John, but while I was ill, I spent a lot of time reading about the cloud. And a lot of this Amazon and Google and Microsoft is this cloud boom, and you saw it with the Amazon numbers yesterday.
Didn't see it with the likes of Microsoft. There was some worries there about the forecast. You saw it from Amazon, which is why I think you're getting such a big pop in the pre-market, the difference between the two there. So that stock is up by about 9%. If you you check out the Treasury market, got to stay on top of this one. It's 5 for 5. Every single day this week, yields higher on a 10-year maturity. Tom, this morning, your 10-year yield at 4.19.
You guys have covered this. I mean, Lisa, I'm sure, has killed this. I looked at like 15 spreads today. It's easy to do off the Bloomberg terminal. USYC is the search function. And Lisa, what thunderstruck me was all the different spreads that really haven't broken down except 3-month 10-year. The T-bill is compared to the note. That's had a sea change move.
The 10-year, to me, is the one to keep watching. Yes, it's the benchmark, but that's the one that has been so consistent and that is breaking out at a time where we're not just talking about more supply, but we're also talking about a balance sheet that's been shrinking steadily by the Federal Reserve. They're not buying in the same kind of way. So who are the buyers going to be?
And this weekend, we're going, after the jobs report, John leaves immediately. He's looking at 6,000 square feet in Larchmont. And, the answer is, I'm sorry, the 30-year mortgage rate broke out to a new high yesterday.
You're killing me.
7.39%. That's a big number.
I'm more of a Bronxville kind of guy, I think.
Yes, you are.
Just that 10 minutes closer to the city than Larchmont. That makes a difference. We can talk about New York suburbs a little bit later. Futures right now on the S&P 500, positive 1/3%. On the S&P over the last couple of days, building a bit of a losing streak. Lisa, coming off the back of a 3-day losing streak going into Friday.
The main event, 8:30 a.m., the change in U.S. non-farm payrolls. It's going to be important because we also have this new data dependent, supposedly. We're also going to be looking at the unemployment rate, really, but what I am watching is the average hourly earnings and where they come in. Will they drop to 4.2% as expected from 4.4%? And is this enough? Is this what the Fed needs to see? Because it is still substantially higher than it was before the pre-pandemic disruption. Today, Saudi Arabia and Russia are having an online review of oil market conditions. They're discussing this with OPEC Plus nations. This, to me, is interesting because of yesterday's ongoing, or at least prolonging, of the 1 billion barrel a day cut that Saudi Arabia is doing. And it is the reason why we're seeing a 6th straight weekly gain in oil prices. This comes as people were looking to this as an area of disinflation, and suddenly it's not disinflating. I think that's interesting. And Saturday, Berkshire Hathaway reports earnings, the latest when it comes to the state of manufacturing, given the fact that we do see a bit of resurgence in certain pockets, and they do have a handle on that, and they are hinged to the train lines and the other things. You're looking at this share price.
It's basically an Apple play, right?
Well, that's what some people are. No, because they have they actually have more oil companies now, and they've got a lot of trains, and they've got a lot of like the classic industrials. And
I wish Mr. Buffet would come on. I interviewed him once. We talked about his train setup.
It might be because that's what you call him.
No, it's because I gave a wonderful interview to the wonderful woman from DLJ who wrote Snowflake, and Warren wasn't happy with some of the questions I asked her about younger Warren.
Oh, it's nice that's on the record. Thanks, Tom,
it's
for
a great
sharing that
book.
story.
It's a really,
tell us
really
more.
good book.
I would say tell us more, but maybe you've told us enough. Steve Whiting, Citi Global Wealth Chief Investment Strategist, Chief Economist, joins us now. Steve, wonderful to catch up with you.
Good morning.
Lisa went through the day ahead there, 8:30 Eastern Time. That's where we've got to start. Payrolls in America. What are you and the team looking for?
Well, look, I think we have a very reasonable consensus of around 200,000, given that private payroll slowed to an expansion, low of 149,000 last month, and jobless claims have stayed very low. The possibility of a stronger report is there. I think that what we really need to see is whether or not the slowdown is intact and whether or not the gains that we've seen in the labor force can persist while we have a slowdown. That would be the immaculate story. But obviously what's going on in the bond market, not pricing in a collapse in the economy anymore, involves higher yields. And I think that what you mentioned earlier, again, the bond market's selling off now. Let's keep in mind that the Federal Reserve is at the top end of the funds rate at 5.5% now. Looking forward, we think it's highly unlikely that this period in which the labor market has outperformed the economy, again, we've been in a slowdown now compared to 2021 for about 5 quarters, that the labor market is not going to continue to gallop ahead of output. We think that there'll be some productivity gains and a slower gain for the labor market compared to the economy going forward.
So, Steve, how is that consistent with this steepening we've seen in the yield curve through this week? If you just take out today's price action and just chop up the yield curve, the 2-year yield's moved a single basis point. The 10-year is up by more than 20 basis points on the week. Steve, what explains that? Just how the yield curve's evolved this week and that drag on the long end, yields up, treasuries down.
Well, there are several factors, including Japan, contributing to some global tightening. And again, a very, very big contributor to the global yield environment is scaring everybody a little bit. I think the bond market is adding to its value. But we also have to remember, we take the big picture here. The 10-year yield has anticipated Fed rate cuts. And we think that we'll get them in the coming couple of years. Take a look at the Fed's own forecast out to 2025, for example. But if you think about this picture, this is the important part. The yield curve has always flattened in a Fed tightening cycle. It has always steepened in a Fed easing cycle. And so that history, again, it's been there for the entirety of the last 60 years. If we're getting through this point in which that the Fed is just simply done tightening, it's not as good for the long end of the bond market. And the short end is priced in probably an unsustainably high Fed funds rate for the longer run.
All right, look, Steve Whiting, at the change here in yields. And the bottom line is there's a whole thousands, millions of people that have never seen this yield environment in any way, shape, or form. And the basic belief is a financial system, we're all going to die with higher yields. You and I lived these higher yields decades ago. Explain to people how we're not all going to die with a 4.5% 10-year yield.
Well, even as some of what's happening in the economy, the housing market just coming to grips at some base level of demand. You mentioned mortgage rates, it's going to hurt. But the housing market has already hurt quite a bit. And it's really the change in interest rates is the impulse to knock down the housing market, for example. And we've gotten used to this yield. Where we came from in 2020 with a 10-year yield at 0.5%, that was an aberration. But I'm also going to tell you, and we've never believed that we're going to a 1980 kind of 14% yield here. We don't have decades of inflation and easing monetary policy behind us. We had this period of COVID upheaval and a period of 25% money supply back in 2020. It's not there now. Money supply is contracting. The Fed is at 5.5%. Our demographics globally don't look and don't poise us here for a period of rapid growth. So I think that we're going to find out that these yields prospectively on the inflation of the next few years, it's about as good as we're going to get.
So does that mean that you pile into long bonds right now and you pair some of your holdings in equities as you sort of try to understand where we're heading and capture the yield that you think is as good as we're going to get?
We did quite a bit of this in the last year or so, and we're not adding to fixed income holdings. We're already overweight at these yield levels. We think that they will be, very solid holdings for the next few years. But there's not a lot of ability here for us to really think that the long end of the bond market will outperform. I mentioned that yield curve steepening trend. It's already anticipating Fed rate cuts. The real sweet spot, again, if you average out different maturities, we think is around 5 years. And there you've got some limited duration, and sometimes you want duration for part of your portfolio, but you've got a lot of yield here compared to where rates will be sustainably in the next 5 years. It's almost like this. You could get across investment grade securities, you could build a portfolio with about a 5-year duration and a 6% yield across different types of credit quality, still staying investment grade, or you could get 5% for the next 6 months. And that's a different story in the Treasury bill market. We think that in the end, you're going to want more duration than Treasury bills, but we're not taking some massive bet on the long end of the bond market collapsing in yield.
Steve, can we get you in trouble before you leave and get you to talk about a single name? What do you learn from Apple and slowing sales? What does someone like you take away from a report like that?
I think it's idiosyncratic in this particular issue. But, look, you can obviously see that in the past for that stock. But the main issue here, I think investors have to compartmentalize, that you have high valued, but incredibly strong, durable, exciting innovation in American tech stocks. But that really, for us, at least in wealth building portfolio, shouldn't be more than 30%, right, of your total equity portfolio across, TMT. And that's where we are now. So if we think about the rest of the world equity markets, which are trading so cheap to technology, again, hold your tech, but we think that there are opportunities, especially outside the United States and in smaller growth stocks in the U.S. Those are things that we're adding at below average valuations overall.
Hey, Steve, thank you. Steve Whiting there of Citi Global Wealth. Steve, appreciate it. Going into payrolls, the number we're looking for, the estimate in the Bloomberg survey, 200,000. That's the headline payrolls growth figure. On unemployment, looking for something in and around 3.5%. Expected to stay, based on our survey, at about 3.6%. For some single names, Amazon doing better than good in the pre-market. Apple at the moment down by 1.9%. Brammer, the takeaway from Apple there overnight, slowing sales growth, just disappointing relative to expectations just a touch.
Even though they did have a better than expected quarter when it comes to China, even though they're talking about optimism in India. And this goes to this question, how much is this the global smartphone market that is contracting? And we saw that from Qualcomm significantly. They can't get out from under it, even as they consolidate market share.
I was surprised in the 430 Zeitgeist yesterday that no one mentioned this is Q3. This is the quarter where Apple's supposed to slow down because they have a moldy June quarter, and then they roll out the September thing. John's been to it a couple times at Cupertino. Here's a new toy, here's a new product. Arif Malik with Steve Whiting over at Citigroup says, look, here's the fact. They're up 8% between a lousy June quarter and when they launch the next toy. 8% from here to September is the average over the years.
I've never been to one of those launches.
I've never been.
I don't get an invite.
I don't have a black turtleneck, so I can't go.
Ed gets an invite.
Can you see me in a black turtleneck?
Yeah, you can work that.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. The Fed is hoping for slowing job growth, but too much could spell trouble.
There is no way that many people would have predicted the kind of data that we witnessed.
Things have slowed down, but they're not falling off a cliff.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
Which nominal wage growth does the Fed need to see?
At what point do people start to say, this is not sustainable?
Maybe this will be the turning point.
The July Jobs Report, Friday on Bloomberg Television and Radio.
This is a very sad day for America, and it was also very sad driving through Washington, D.C. and seeing the filth and the decay and all of the broken buildings and walls and the graffiti. This is not the place that I left. It's a very sad thing to see it. When you look at what's happening, this is a persecution of a political opponent.
That's the view of the former President Donald Trump after appearing at a federal court down in Washington, D.C. Plenty more on that in just a moment. From New York City, payrolls just around the corner. You know the estimate now, 200,000 going into it, the state of play. The price action looks like this in the equity market on the S&P 500. Equity futures at the moment, slightly positive by 1/3 of 1%. 3-day losing streak into Friday and trying to bounce. Trying to help that bounce is Amazon, which is up big time in the pre-market by close to 9%. In the bond market, as you were, Monday, Tuesday, Wednesday, Thursday, hello Friday, yields up higher by another couple of basis points, Tom, 419. This is a move close to 24 basis points higher on the week. Pick your poison. Lisa and I have been doing this over the last couple of days. The data, nah, probably not. The downgrade, shrug of the shoulders by most people, Tom.
Yeah.
The Treasury supply, that's a real story coming out of the Treasury.
It's a real story in the hockey stick chart, which is the interest expense of the federal government, is something as well to look at there. What I would focus on, John, is you go to the BTMM screen on the terminal and you say round it up to 6%. And the only real number I have where I can say round it up to 6% is 3-month LIBOR, which nobody pays attention to anymore. It's old news. But the bottom line is we're not yet to the cusp of rounding up to 6%, but boy, are we getting close.
Getting closer, right?
Yeah, a lot closer. Let's turn to politics right now, the politics of the United States of America. We do this so much for our international audience. Wendy Schiller has advised us with Brown University, the Taubman Center for American Politics. Wendy, I want to go to the word cumulative. We're using it in economics now in the Fed. We have cumulative indictments. What is the difference between this single event of yesterday and the fact there's been 1, there's been 2, there's been 3, and dare I say there could be 4? What's the difference, the distinction?
It depends on the audience, Tom. It's a great point. Is for Trump supporters, really very loyal people who've stuck with the former president, this just emboldens them, keeps them more loyal. Their team is losing and they're going to basically be on that team and nothing is going to shake them. So they get more emboldened, but I think it continues to turn off independent voters who were the swing voters in some of these key states that former President Trump lost in 2020. So the audience that gets disgusted by sort of 3 indictments, that audience was leaving anyway or already left. They're not going back to Trump. But the Trump base, particularly coming up into the primary, is more emboldened and wants to defend their president. We'll see if these donations keep coming in, the small money donations that he's been using to pay his defense funds. That's going to get more expensive. Does that money keep flowing in?
Right. Well, Professor Schiller, what I find fascinating here is the zeitgeist, in the last 24 hours, there was one idea of how small the Trump audience is, yet obviously very loyal and all that. What are the other Republicans doing? Are they waiting? Are the Republicans moving to independence? Are they moving to a relative conservative like Biden? I don't believe they're going to move to a liberal Democratic stance. But what are those Republicans doing right now that have had it over the indictments?
The Republicans that are, not for the former president are just holding their breath, I think, and thinking, okay, what do we do? I mean, Republicans are really good about coming home to the party nominee. The exception was 2020. But typically, even when there's division, as we saw in 2016, Republicans come home to the nominee and they get out the door and they vote in presidential elections. Right now, the question is, will anybody, including DeSantis, come up and challenge the president enough to make it worth investing in somebody else, either with money or with your vote 6 months from now? But essentially, I think that's the stance right now. Is this person really going to make it? The House Republicans have already all in on Trump. I mean, that's it. That game is over. So they're with Trump. But the actual rank and file, we have to wait and see for 6 months. When the reality that this man will be the nominee again and that he could be president again really hits home, do we see any diversion in some of these Republican Party voters?
And that seems to be what Elaine Kmark of Brookings said yesterday, that she doesn't think that Donald Trump will be the nominee in the end, and that essentially people will move away from him as it becomes clear that he will not win the general election. From your vantage point, what's sort of the tipping point and who is the likely person to emerge at a time when yesterday we were talking about Tim Scott and how he has become the Wall Street darling in some ways, at least when it comes to fundraising?
Yeah, Elaine has been in politics a long time and knows what she's talking about, but I've shifted. I thought he wouldn't get the nomination, and now I just don't see enough people getting out the door to vote in the primaries coming up 6 months from now to knock him off his perch. I think we have to see the Iowa polls seem to be shifting a little bit. DeSantis seems to be gaining some ground. If DeSantis can gain a little bit of ground in the next couple of months, then he becomes worth a second look for primary voters and investors, campaign contributors. So we just have to see if he can get any momentum. Even if he's losing to Trump, momentum will probably, reignite his campaign. Then he becomes sort of the obvious option. But he's got some real liabilities in the general election as well. So I'm not sure the electability factor for DeSantis actually, gets him over the top and defeats Trump in the primary.
One thing I keep thinking about is that the entire pitch for President Biden to run again is that he is the only Democratic candidate who could win against Donald Trump. This, though, at a time when his grassroots fundraising is really lackluster. He's not getting the small donations that really indicate a healthy, popular campaign, and his popularity ratings have flagged. Does it look less and less likely that he can win re-election if he's against anyone except for Trump?
Yeah, I mean, I think that's a big question, Lisa. But when we look at the economy, which at the moment seems to be settling down, and the doom and gloom and dire predictions seem to be diminishing, unemployment stays relatively low, inflation gets under control a year from now or more than a year from now, voters are going to say, okay, things are pretty good, things are pretty stable, and if Trump is the nominee, then we go back to chaos. I think that in the end is literally what saves Joe Biden and gives him a re-election.
Wendy Schiller, thank you, Wendy. Wendy's view at a Brown University this morning on the indictment that we've seen so far this week. Tom, the appearance in court a little bit earlier yesterday afternoon. The drama goes on.
The drama goes on, and to me, it's the overlay. What's unprecedented is 1, 2, 3, and then whatever we see out of Georgia. I'm just speculating on that. And clearly, for our international audience, we've never been here. I can think of scandals over the years. One isolated thing, all of Watergate, which I remember in Technicolor. I think I was a junior, senior in college, whatever. But there's no comparison to what we have right now.
We just went through the 1, 2, 3. So we're talking Florida, Washington, New York, and maybe going down to Georgia as well.
Georgia, I believe, would be 4. I defer to Tim O'Brien and his wonderful leadership on this at Bloomberg Opinion, but I think the cumulative nature of it is something that's truly unprecedented.
Away from the politics, Tom, I think one thing in Washington that we've really got to focus on is this Treasury supply story that really got some fuel earlier this week when the Treasury had to come out and basically lift its estimate for issuance in this quarter from 733 to 1 trillion. And what Jim Reed at Deutsche Bank and others are trying to figure out, is this some kind of South easing? We know
Suddenly. It's amazing in fiscal economics how everything's wonderful. There's a wonderful glide path. And then suddenly, and I'm not saying we're at suddenly, but you've got a set of moving parts that can change rapidly, where suddenly is August or suddenly is the end of the fiscal year.
Well, suddenly this week, Lisa, this bond market woke up close to 420 on a 10-year right now.
And what's interesting, and we were talking about this, it's been a slow grind, but then suddenly it reached a level with the Fitch announcement that sort of crystallized a lot of things in people's minds, that suddenly it got the attention of risk markets. And now it keeps climbing, even amid this. And yesterday, Tom Sisora is saying real money buyers aren't coming in yet because they want to see how far this is going to go and they want to capture the most yield.
Fitch just turned the volume up on a story this week to get everyone to talk about something that many people are already focused on. Equity futures right now on the S&P positive by 1/3%. On the US economy, on the jobs report still to come. Sarah House of Wells Fargo coming up next.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
It's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do.
Payrolls 2 hours away. Your equity market set up as follows on the S&P 500, on the Nasdaq. I think we have a countdown clock. It's there, Tom. Yeah, it's on screen.
200,
Great, that's helpful.
14, 13,
just in case you forget.
12.
On the Nasdaq, positive by 0.5%. You can thank Amazon for that move because Apple's down in the pre-market. We'll get to those two movers in a moment. In the bond market, off the back of this 3-day losing streak in the equity market, it's been 5 days of it in the bond market. Yields up, 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 up. Is that 5 or 4? Anyway, yields up by a basis point this morning to 418.59 on a 10-year, on a 2-year up by 4 basis points to 492. Tom, this has come all at the long end, pretty much almost exclusively. We're higher by something like 5 basis points at the front end of the curve, but higher by more than 20 on a 10-year this week.
10-year real yield's increased. I mean, the real yield has gone from a 150 to a 181. I mean, there's some interesting gyrations here, but John, you're correct that all of this is out past 10 years. The 2 years, what, 1 beep, 2 beeps, whatever.
Hardly anything.
Hardly anything. And of course, it all spins around what the Fed does in the 3-month to 2-year space as well.
The supply story from the Treasury earlier this week. We'll talk a little bit more on that a little bit later. Let's finish on foreign exchange. A rare piece of decent data out of Germany. It's an upside surprise on factory orders. It's backwards looking. It's a few months old, but we'll take it in Germany right now, won't we? The euro against the dollar, 109.45. That currency pair just about unchanged. Under surveillance this morning, counting down to the payrolls report at 8:30 Eastern Time, 200K, the median estimate in our survey for non-farm payrolls. A range of views on the street. City at the high end at 290. JP Morgan looking for something like 175. The range, Tom, is actually pretty tight. I think it's 150 separating the low and the high for the broader survey that we conduct here at Bloomberg.
McKee didn't whisper to me the whisper number as well, but I agree with Lisa. This is about wage numbers. And I mean, the bottom line is if you do have this new sticky inflation, if we're not going to get to 3.5 or at 4 or whatever, 4% real wage, 4% nominal wage growth doesn't get it done.
Yeah, and Lisa's right to talk about this. This story right here. The United Auto Workers Union asking for a 40% pay rise over the next 4 years from Detroit's automakers. This according to our reporting here at Bloomberg. The request coming as contract discussions with GM, Ford, Stellantis are all underway. The current labor contract, Lisa, that pact expiring next month.
They called it an audacious list of demands, the UAW themselves. And they were talking about how they wanted a 40% raise because that's what the executive had gotten. And if the chief executive officer could get a 40% raise, they could. And just to put this into hourly numbers, the average wage or the top wage is about $32 per hour. There have been 3% increases since 2019. It would jack it up to $47.14. So that's kind of where we're at with how much of a gain this would be.
Two quick observations here. One is take $29 million, the Maribara compensation that Greg Villiers writes about this morning, and compare that to $67,000 a year at $32 per hour. That's 435 to 1. That's foundationally different from Mr. Sloan's GM or the GM of my ute. I mean, this is a huge difference in equity and cash compensation to executives versus any kind of union number. And the other thing I look at here is just it's the return of labor power of the interview that Lisa, we did. I can't remember if I did it with John or Lisa with the Teamsters. And I'm sorry, this is Teamsters influenced here. This is the knock-on effect. Forget about this Hollywood stuff. This is for real. I mean, the history is people used to get shot at, John, in America over this stuff in Michigan.
In Europe as well.
Yeah.
It used to be quite a violent thing. Some terrible stories about that. I think the Hollywood story is pretty real as well, Tom, by the way. This one's real too. BA, British Airways, 24,000 employees getting a pay rise, TK, over in the UK. 13.1% that pay rise. So just another deal for you. This is over an 18-month period. There's going to be a bonus, a one-off payment of £1,000 in the mix as well.
Yeah, but the bottom line there is I can't get a seat back from the Atlantic on my Avios points. That's the reality.
Don't get me started on Avios.
It's useless.
I've got things to say about useless
Avios.
It's just
completely. The thing is, they can get you to Europe,
There's
but
inflation
they can't get you home.
You try and get an upgrade, Bramo, with BA points, and it's like, yeah, those seats aren't available.
Okay.
Every single flight you try and do that with.
My completely uneducated take, just in general on points, use them now because there's serious inflation and they're worth a lot less later on. So every month they go on, they lose it because they're basically trying to ramp it in. Anyway, carry on.
I've got things to say.
I know.
You've got things to say. Got things to say on Amazon and Apple. Amazon shares up in the pre-market. Nice move in early trading for Amazon going into the opening bell. It's a beat and a race from them. The concerns you had about cloud revenue growth at Microsoft, you don't seem to have over at Amazon. That stock is up by 9%. Let's sit on Apple just for a beat. The good news there ain't much, that's for sure. Third straight quarter of declining sales, slowing demand for phones, computers, tablets, TK, take your pick. This line from KeyBank, and I'd love to get Dan Ives' thoughts on this, and we'll talk to Tom Forte about it later as well. KeyBank raising this concern, worries that the US upgrade cycle is coming to a halt. The upgrade rates are at all-time lows and likely to result in weak revenue here in the United States. That was the bullish thesis, Tom.
Yep.
Upgrades, ready to go, and let's focus on the upgrade rate now.
Every 12 months like clockwork, slow June, slow summer, September, back to school.
It's dead, then
back
everyone
to
comes
holiday
out.
season, new product. Will they show up? We don't know if they'll show up. Sell Apple. I mean, that's the way it always is.
Selling it this morning. Stock's down, TK, by, let's call it 1.9%.
1.9% after going up 400% since February or March. Right now, we're going to advance forward on this jobs report. Sarah House has been wonderful, senior economist at Wells Fargo, and joins us this morning. Beneath the headline data at 8:30, what's the first thing you will look for?
Right. So I think, obviously we'll be keeping a close eye on those headlines, not just the hiring, but also what's happening with labor force participation. But I'm going to be looking at some of the, less known sides of things that maybe are potentially showing that we're starting to see some cracks in the foundation of the labor market. So for example, permanent job losers. So those have increased about 20% over the past year, about 300,000 workers, which doesn't sound like a lot, but that's on par with what we saw in between late 2006 and summer of 2007 before things really started to unravel in the jobs market.
Are we beyond the pandemic? I mean, can you study this without the prism of going back to late 2019, early 2020? Are we beyond COVID?
No, I think we're still seeing some lingering effects of the pandemic on the jobs market. So everything from the rate of hiring to the labor supply. There's still some industries like leisure and hospitality, like government, that have scope for catch up. So those industries still don't have employment back to where it was in 2019. And so I think that's going to help bolster payroll growth still over the next few months, even as we have seen demand for workers come down. And I think, we're still very much seeing the effects of the pandemic when it comes to the wage dynamics as well.
Sarah, I want to ask about what's happening in the bond market, not directly on treasuries. I know that's not your seat, but yields are up again this morning. And it's not about the data this week for many people. It's about treasury supply. From your standpoint, is fiscal policy in conflict with monetary policy at the moment in America?
Well, I think we are starting to see some of the effects of the fiscal support that we saw over the past few years. It's waning. So yes, you still have some support in terms of like the infrastructure money flowing through the economy, but I think that rate of change, it is beginning to work more in concert with monetary policy, but not as aggressively certainly as what we're seeing in the monetary policy sphere.
What's behind that additional supply? Tax receipts are down. What's going on exactly? There are people asking a question as to whether this is stealth easing coming out of Treasury. What is it?
Well, I think it might also be in part of just trying to rebuild the cash balance in the Treasury General account following the debt ceiling. So I think that could be part of it.
Although a lot of people are speculating that it's unlikely that the U.S. government's going to get their fiscal ducks in a row, considering the fact that there is no appetite on the campaign trail. At what point does this become a material risk to the economy if yields remain at the levels that they are?
Yeah, so I think where you'll really start to see it and see some more focus is what happens in terms of that net interest expense. So it's something we really haven't had to think about for years and years, even with these ballooning deficits, given the low rate environment. But of course, with where rates are today and where they're likely to stay, that's going to become an increasing problem. And so where that starts to play out is how it squeezes out other types of more productive spending in the economy.
Which brings us back to the labor market and how long it can continue to sustain some of this spending, which has fueled gains even as some of the higher rates were supposed to end up crimping growth. What are you seeing on the services side, especially after the ISM services yesterday that showed the headline number softening just a touch, but the component of how much people are paid actually rose unexpectedly? It doesn't seem to be going in the right direction.
Right, so I still think we're seeing a lot of inflationary pressures coming from the labor market. I think you're starting to see it cool down, but ultimately when you're looking at a cross range of wage and compensation measures, you're still seeing compensation growth north of 4%. And while we did get some stronger productivity numbers yesterday, even with some improvement in the recent trend, that's just not going to get back to 2% inflation on a sustained basis. So it's going to get us closer as we start to see those wage gains come down, but right now we're still seeing that inflationary pressure from the labor market remains too strong to be consistent with the Fed's 2% goal.
Sarah, we've heard from a number of different people in the past couple of weeks that they think the Fed is going to move to an explicit or implicit, we're not sure, 3% target or 2.5% target instead of the 2% target, that they're going to say it's not worth putting a dent in this labor market and bringing those wages down in order to get to the 2% target. Do you agree with them?
So I think over the medium term, so let's call it another year or two, I think that's broadly right. So I think the Fed can live with 2.5%, certainly 2.25% inflation after all the rigmarole we've been put through in the past few years. But I think, for the long-term target, I don't think that changes. Right. And so I think where you end up with is policy is going to be on net a little bit more restrictive, maybe a little bit above that long-run estimate to, I think, once you get past the worst of the recession fears, that you still get some downward pressure to get back to 2% over time.
Sarah, to the heritage of Wells Fargo and the idea of Jay Bryson's work and the great John Sylvia, you've always had a unique take on the American labor economy. Are we reunionizing? Is there something going on here besides just news on one union, news on that union? Are we reunionizing?
I wouldn't quite go that far to say that we're reunionizing, but I think what we have seen is a reflection of the still incredibly tight jobs market and all this union activity that we've seen, both in terms of some pretty heated negotiations, as well as a pickup in actual strikes and increasing number of workers actually out of work because of these work stoppages. But it's also, of course, a reflection of just the extraordinary inflation environment we've seen. So if you look at the employment cost number, so union compensation has lagged that of non-union as a lot of these contracts were made before we saw inflation really shoot higher. And so I think to some extent this is a little bit more catch-up rather than a signal that we're about to get another leg higher in terms of wage growth. But it does suggest that it's going to keep those wage pressures elevated and again make it hard to get back to 2% inflation anytime soon on a sustained basis.
Hey Sarah, thank you. Ahead of payrolls, Sarah House there of Wells Fargo. The median estimate at the moment, 200K. TK, remember in the 70s when union membership, the rate of private sector workers was something like close to a quarter. It's come down dramatically since then. I've asked the question a few times over the last couple of years, can you imagine how much worse the inflation problem might be if union membership now was consistent with union membership back in the 1970s? The pass-through from headline inflation into wages would have been far more dramatic than we've seen.
Very European-like. And the big difference here is whereas Europe right now, and particularly whereas Germany here, the guild heritage and all that, versus America, what you do in America, John, is you take out public service unions and then look at the private sector, and that's where it's atomized. That's the word they use. And the answer to my question to Sarah is the idea of is there an ebb and flow here? And I think it's worth watching. What gets my attention is everybody goes, oh, no, it couldn't possibly be reunionizing. And that's when my radar comes up.
We're certainly hearing more and more about it every other day at the moment. Coming up shortly.
The control room?
On Apple,
they're
on Amazon. Yeah, we can do two conversations at once if you want. Let me just do the tease.
Okay,
Tom Forte, D.A. Davidson on Tech Earnings. They're unionizing.
They are.
Is that happening?
Yeah, they got 15 people.
Who's leading the union?
I know, there's 15 people.
I'll get them together. I could do that.
You're going to be the leader?
Yeah. I think that's sort of very on brand.
You're like, look, if you're going to do it, I'm going to lead it.
I think full communism in a control room. It's very on brand.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
People are employed, they have money, they're spending money, and the Fed is trying to slow down the economy, and it looks like we're reaching a pretty good equilibrium. I think there's always been this battle between the consumer and the Fed, and the consumer has won the battle back a bit, but they got to be careful of overwinning it now. And now the risk really goes to over-tightening and slowing down the consumer too much, and then we would have a recession.
It's one of my favorite things about Brian Moynihan of Bank of America. He refers to the work from his research team.
He does.
When he talks about the economy, he's talking about what Mike Gapin is writing about at BFA.
Mentioned Constance
Huge
yesterday
respect for that.
with David Weston, and I totally agree. He's one of the few people that really stands out. I think, Moynihan's going to be, he was here for the Ethan Harris interview. He was over there off camera, and, I think Brian's going to fall apart with Ethan going out the door.
Retiring.
Retiring, yeah.
What a generation of economists that have learned under him. It's kind of amazing. You go through it name by name, and they're all in different places now, but quite a legacy that Ethan Harris is leaving behind on Wall Street.
And Bill Dudley was the same way.
Yeah.
At Goldman Sachs.
Still around, and hopefully we can catch up with Ethan now and again as well. Let's touch base with the price action. Equities right now on the S&P 500. Equity futures are just about positive by 0.3%. Two names I want to look at. Amazon, Apple. Amazon up in the pre-market by 8.9%. Apple a little bit lower by 1.8%. Amazon doing the heavy lifting for the NASDAQ this morning, TK, with a tidy rally in early trading.
It's a tidy rally is that. Let's go to Apple first here, and the whole idea of OMG, they're down 1.84%. And somebody that absolutely nailed this, I mean, Dan Ives comes on, and let's be honest, he's all dressed up like Fruit Loops. I mean, we were talking about Fruit Loops earlier. He's got the Fruit Loops
You can
sneakers.
tell Dan that yourself.
He's got the Fruit Loops, you know, the turquoise shirt going, and he's the Uber bull on Apple. There's others out there more measured, and one of them is Thomas Forte, senior research analyst at D.A. Davidson. He's got a neutral. He's measured. He sees the optimism. But, John, you were talking about this off camera here when we weren't talking about, you know, does Barbie have legs 3 weeks in? And the basic idea here is the Apple mystery is, are you going to go from the iPhone 10 and finally spring up to the iPhone 15? I don't, you know.
For any kids listening, Barbie still has legs. Okay. I just want to, you know, just confirm that. Just confirm that.
Oh, my God.
Tom Forte joins us now. Tom, it's good to catch up. Catching up yesterday was really revealing as well. Some insightful comments you made on Apple, where you essentially said, and you've written about this, you think maybe the stock had gone too far. We're down this morning by 1.8%. You're aware of the bullish thesis, Tom. There's this upgrade cycle. Lots of people sitting on old phones. They're all going to upgrade and buy new ones. Where is the upgrade rate now going into the new launch of new products in a month or so?
So the most concerning statistic from Tim Cook on the call yesterday was that consumers, more than half, are already paying for their Apple product on an installment basis. So I think the low-hanging fruit's been picked to the extent that that was the opportunity for Apple to get you to go from buying your iPhone or having your iPhone essentially fully subsidized by the carrier to now having the consumer pay for it on an installment basis, often with no interest. I also am concerned that the carriers are going to subsidize the 15 to a lesser degree than the 14 or 13. Yes, they want more consumers on their 5G networks where they've invested billions, but their times are tough too right now. So the comments on the iPhone are concerning, and I think that's what's weighing the stock.
Tom, away from your neutral call and to go to the Apple fanboys and all that, the bottom line is it's an ugly June, ugly July. It happens every year. We have to wait for September. Somebody with a black turtleneck walks out on stage and tells us the second coming of Apple, and OMG, the stock goes up. Why is that going to be different this time?
It's going to be different this time because I think that they just told us that the September quarter, where they're going to tell us about this new wonderful iPhone, is going to have negative revenue growth. And that while the iPhone will have an improvement from the negative 2.4% it did in the June quarter, it'll likely be negative as well. So yes, they'll be touting every new feature on the iPhone, but the comments they made about the financial impact are pretty disappointing.
The Open Prayer Services picks it up and crosses. How far out do you go where services catches up and advances and overcomes iPhone dynamics? Is it a 3-year lookout? Is it out 10 years? How far out is that magic point where services become really important?
So the math suggests it's probably more like 5 years when you think of the relative growth rate of services to everything else. But if you look at the quarter, hardware was down, iPhones were down, iPads were down, laptops were down, services was up. That's great news. And I do believe over the long term, Apple as a service is a real possibility. You pay $200 a month, you get the latest and greatest iPhone, you probably get Apple TV and other things, and then you're not thinking about the fact that you're essentially paying $2,000 for that new iPhone. You're just thinking about the $200 a month and getting the latest and greatest iPhone. I think that that's the opportunity in the long term, but mathematically, I think it's more than 5 years out before services is more than half revenue.
So, Tom, you did decrease your price target for Apple, but you increased your price target for Amazon after they delivered much better than expected results. And suddenly everyone's heralding Andy Jassy as the hero of Wall Street. How long can this be the case for him to keep cutting and keep beating on the top and bottom lines across the board?
My best answer right now is that this is 12 months. So they just had their good June quarter, their good outlook for the September quarter. They'll have a good December quarter and a good March quarter. I am very concerned that at some point reality sets in. And to the extent that these cost cuts are making them less customer-centric, that's going to slow the flywheel, price, convenience, selection. So I think the next 12 months, they're good. Day one of the next year, I'm concerned.
Some people might argue that the cloud business is going to take over all. It has done the heavy lifting for all the profitability of this company, and it showed signs of picking back up. There will be questions about whether it's gaining market share versus Microsoft's Azure. How long can that really be the main flag bearer for the company? I mean, is that enough to really offset what you see down the line on the customer service side, in the sort of retail side of things?
The answer is not long enough. So we're cheering a 12.2% growth rate compared to a 15.8% growth rate when they reported the March quarter, though it is better than the 10.8 they suggested in the month of April. That's the slowest growth rate since AWS was launched in 2006. Andy Jassy's bragging about double-digit growth as if it's not going to be sustained. So a lack of double-digit growth for one of their most important profit centers is hugely problematic, especially given the current state of their e-commerce business. Amazon collectively needs something like $3.4 billion for an incremental basis point or a percentage point of revenue growth. They're going to need advertising. They're going to need video. They're going to need healthcare. They're going to need something else to come in to take the baton from AWS over the long term.
Tom, can you describe how service on the e-commerce side has deteriorated over the last year?
Yes. So the best example is anecdotal. So I had a defective smoke alarm that I purchased on Amazon. Not that long ago, they would say, we're sorry it's defective, we'll send you a replacement, put the old one on your porch and UPS will pick it up for free. Now they want $7.99 for UPS to pick it up, or they want me to go to Whole Foods, wait in line at Whole Foods to return it. So that to me is one example. What's going to happen is I'm going to start thinking more about going to Target. I'm going to think more about going to Walmart, to Costco, to other retailers. And I think that's hugely concerning for Amazon, something I'm monitoring closely.
It's anecdotal, but I hear the same thing from so many people. Tom Forday of D.A. Davidson, great call on Apple going into the earnings just yesterday. Water's not available, but it is. And I know the water's available.
What are you talking about?
You order the water with
Lisa,
your food. You get Whole Foods
enter
delivered.
2023.
And they turn around every Friday morning. Let's see if it happens again when I get home. And they say the water, the bottled water's not available. And I've always wondered, is it the weight? Are they just pretending because it's the weight?
No, I got my sparkling
Same thing.
water.
Happens every single week.
I love the detail.
I got my sparkling water yesterday. Yesterday.
Don't dehydrate.
You know what the problem is? Ready? It's like plastics in The Graduate. Ready? Bananas. I've given up ordering bananas.
Are they saying they're not there?
No, they come, but they're not like if I pick them. They're like you can't do fruit because they don't pick the right fruit. I mean, I'm getting it.
This is good. This is important. I think we just get it all out there.
This is like what Tom Forty. This is why 40's so
I'm agreeing
good.
With Tom.
It's anecdotal stuff. It's not CFA blather. Bananas.
Bottled water.
Excuse the cough, folks.
Same thing.
Sorry.
I know what everyone's going to say. Drink out of tap. Get one of those disposable
you're going to get
things.
lots of people.
I love it. You know what I learned with Whole Foods? This is important. At Whole Foods, when you get down to where you deliver, you put don't substitute. So they can't sneak things in there they want to get rid of.
Raised with an Italian father who refused to drink tap water because he came from a place where you couldn't. So we were raised just drinking bottled water. It's just what we did.
True story.
Cultural.
One of the offspring is in Europe. He said the tap water is not very good. He's excited to come back to New York City for the tap water. Tap water is awesome here. It's very good.
He's excited to come back from Europe for tap water.
It's good tap water. It's really good.
That's what he's excited. Oh my
That's one of them. Yeah, it's.
I'm gonna have a word with him. Sarah Hunt of Alpine Saxon Woods up next.
Tonight, Wall Street Week comes to you from Colorado. Join David Weston for the 2023 Aspen Economic Strategy Group meeting. Special guests Cecilia Rouse, Raphael Bostic, Brian Moynihan, David Cody, Austin Goolsby, and Larry Summers join David Weston for exclusive conversations on persistent inflation, rising debt, and demographic challenges in the U.S. and around the world. It's a Wall Street Week you won't want to miss. Tonight at 6 p.m. Eastern with replays all weekend. Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI
AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's just not a surprise that we're pulling back here.
There are signs of weakness in the economy coming through.
Investors are stepping back and saying, we're going to wait to see how far yields rise.
What you want to see is inflation slow credibly and sustainably.
Until a recession does materialize, we can expect high rates for a period of time.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on Payrolls Friday, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. TK back in a seat especially. The jobs number 90 minutes away. We're looking for 200K in our survey, Tom. And this bond market, softer again. Yields up through the whole of this week.
A little under the weather. I decided to come in for the Super Bowl 13 times a year. We have the actual Super Bowl and Jobs Day. And Jobs Day's, you know, it's a big deal, and it's a big deal within the backdrop of what bonds have wrought over the last week. The bond movements are really not game-changing, but they give you something in the summer to talk about to get to Q4 of this year.
Hasn't been a quiet August so
far,
has it?
Not at all.
Yields up every single day this week, Monday through Thursday, add Friday. Yields up here, Lisa, by a basis point, the 10-year, 4.18.
I'm glad you pointed to the 10-year, and that's the reason why I'm actually really curious to see whether the jobs data moves the needle at all for the 10-year. Basically, at a certain point, this is not about the Fed. This is about the Treasury issuing more debt. This is about the Bank of Japan maybe moving away from something that's underpinned the valuations in so many of the developed market worlds, particularly the U.S. So here's the question. At what point does Fed lose control over the narrative and get the sense in the market that they're not going to respond to any strength, that if it comes in, you get this sort of deterioration, you get a feeling longer term, there's still going to be inflation.
I do not agree that it's this macro stuff. The macro stuff is tangible. It deserves our focus. Look what Fitch did. We all woke up with Fitch and said, OMG, we're a banana republic. But the bottom line is this is about like inflation Canada. Sticky. And Michael Gapin, when he wasn't, when Michael Gapin wasn't advising Brian Moynihan on what to say in the economy, he put out a great chart. It was a fan distribution of the inflation outcomes that are there. And what's really happened here in the beginning of August is, OMG, we're not going to go to 2%. It may be 3.x or 4.x stickiness is the real debate into this jobs report.
I've waited 3 days to take that dig at Canada. Apple in the pre-market, negative by 2%. It's nothing personal. Amazon positive by close to 9%. Apple just about in line with expectations, a bit softer on iPhone sales. But to look at Amazon here, Amazon up by close to 9%. There were concerns about cloud revenue growth going forward from here over at Microsoft. Lisa, you did not see that at Amazon overnight.
On any level, what you saw is job cuts, yay, and increased profits, yay. Everyone's piling in. The question is, as we were talking to Tom Forte, how long can it last? And at what point can people keep projecting out this type of growth at a time where there are some headwinds and there's a lot of competition? I think that's important, especially in light of what we keep hearing, which is the consumer can't keep this up forever. They've managed to, much longer than people thought, but they can't keep this up forever. That's what everybody's saying.
That stock just about holding up this equity market at the moment on the NASDAQ, given its weighting. On the S&P 500 here, Lisa, equity futures positive by, let's call it 0.2%.
What we're looking at today, obviously 8:30 a.m., the change in U.S. non-farm payrolls for July, the unemployment rate. John went through that. 200,000 is the expected number. What I'm watching is the average hourly wages. How much do they continue to climb? How much does it decelerate from some of the increase that we've seen recently? If we get down to 4.2%, here is the key question for the Fed. Is that enough to sustainably say, okay, we're happy with this, we're still going to remain on hold or even cut rates in the near future? Today on the oil front, as oil prices continue to climb, Saudi Arabia and Russia are holding an online review of their market conditions, and OPEC plus nations will weigh in. How long can we see an increase in oil prices before it becomes the main story? Because it has been 6 straight weeks of oil gains, and it seems to be gaining some feeling of momentum from what Saudi Arabia did yesterday in terms of maintaining production cuts. And Saturday, we get the word from Warren Buffett. Berkshire Hathaway reports earnings. Very curious to see what he has to say about the industrial production complex in the U.S., given that he is so heavily invested in them. And yes, of course, Apple.
Is this the Omaha thing? Have you been to the Omaha thing?
No, never been.
Is this weekend? Are we going to do that?
That's
He
tomorrow.
plays the ukulele and.
Oh, that's tomorrow.
Yeah,
the
that's
get-together.
tomorrow. Well,
Yeah.
it's no,
not the
tomorrow's the
get-together, is
earnings.
it?
No, it's not the
not
get-together.
the
We already
annual
had the
get-together.
annual get-together, but the earnings are
He's
tomorrow.
never
cult thing,
invited me
whenever-
out.
Yeah,
I
yeah.
can't
We
imagine why.
covered the full cult and how you felt about it.
The full cult. You like that? Going full cult in Omaha. Bramo, they were your words, not mine. Sarah Hunt joins us now, Chief Market Strategist at Alpine Saxon Woods. Sarah, good morning to you.
Good morning.
We've had these tech earnings now, and I wonder, from your perspective, do the tech earnings justify the double-digit gains we've seen so far year to date in this equity market?
I think so far they may have. The question is going to be about what is coming next, right? So that it's all about the outlook right now. So it's very good that Amazon had good numbers. If you look back at the way Amazon has performed versus Microsoft or Apple, it was not performing as well. So it did need to do something, relatively speaking. And it's not a huge surprise that Apple is having a little bit of a give back on unit sales on some of the hardware, because you had, just like everything else, huge extra sales during the pandemic. The thing for Apple is that gives them a bigger installed base. That whole services revenue story becomes more and more important, and they're adding that. So I think that that's good news. The question really is going to be what's going to happen going forward, and the expectations for next year are some pretty serious growth, and I think that's where it's going to be a little bit tricky.
Lisa and me are in the same camp on this, in the same camp, because every time you get these earnings from these tech players, we look for this kind of macro signal. Before we get into that with Apple, can you tell me if the iPhone is a staple or a discretionary item? Because when you start to see slowdown there, is there a broader economic signal that I can take away?
So I think because of the pandemic, that's a more difficult question to answer right now. In a normal environment where you hadn't had everybody staying at home and people saying, you know what, every kid needs an iPad because they can't share anymore because they're home all day. I think that changed the math of that. So I don't know that you can have a huge read into that, except that people possibly overbought or they ordered quickly because they were afraid that they weren't going to get something. I had to wait for my iPad. Everybody wanted one, right? So now you are going to wait for the upgrade cycle. But the fact that they're seeing a lot of switching is positive for that upgrade cycle. So I'm not sure that that's a huge macro takeaway, especially given how so many of the pandemic stocks had a much stronger slowdown post-pandemic. You know, that's not a huge surprise that you should see some of those units coming in.
Mr. Buffet, as 40% of his Berkshire Hathaway is Apple, and that's been a growth proposition going back 7 years, 2016, where Apple's just built and built and built. Carry that over to our listeners and viewers. Do we really lighten up on tech here, or do we just assume that they keep growing as Mr. Buffett has enjoyed seeing Apple grow?
I think from the longer term, they keep growing. I mean, this was the argument at the beginning of this year, right? Which was last year, the tech stocks got hit very hard. And one of the things that we've talked about historically is that some of those things become staples. Is your iPhone a discretionary item, or is it something that you have to pretty much have with you when you leave the house? Does it feel like I can't live without my phone? It sort of does. So I'm not sure whether or not that falls into now a consumer staple as opposed to a discretionary item. But I think that the question is, can I keep seeing better performance out of these stocks than the rest of the market? And I'm not sure going into next year how much of the earnings growth is going to come the way people expect it. So, and I'm not sure if that's only about technology or about the entire market, because I think that there are some concerns there.
We're having this conversation at a time when yields are rising to the highest levels since November, but really kind of pushing up against some of the highest levels that we've seen in a long time. And I'm wondering how much that changes the conversation, how much that changes your thesis in terms of valuations and where that correctly is placed in the equity market.
So I think that this is one of the things that we've also been saying all along, which is that it's hard for me to believe that the Fed is going to cut as fast as people expect them to. So we sort of expected rates to stay a little bit higher for longer. The question really is, how high do they stay? Because the question about cutting rates so quickly, right? We're still at a point where we're not at 2%. I'm not sure we get there that quickly. And everyone's talked about how difficult that last 1 percentage point or 1.5 percentage points of inflation may be. You may see inflation start to rise because oil prices are on the move and food prices are higher. So I think that it's going to be difficult to see rates coming down in that way that they did in the last 15 years, that every time there was a scare, rates came down very, very far. There was an article on Bloomberg about how the stock market can continue to rise even though rates are going higher because multiples can continue to expand. And I think it's just going to be, you're not seeing that trade-off between tech and rates the way you did last year. Every time rates went up, tech went down. You're not seeing that right now because tech has come through with good earnings, even in higher rates. And they've got so much cash, they're now earning money on some of that cash. So that whole idea that tech is going to be in trouble because rates are going higher is a little bit difficult on the very mega tech side to see. So I think that's going to depend on how we see next year. But I think rates are going to be higher than people want them to be for a little bit longer than people expect.
Surely it matters why they're higher. If they're higher because the data's been better, then you can make the argument that it should be good for risk assets. If yields are higher because the Treasury is issuing more and potentially crowding out the bond market and yields are up for that reason, isn't that a little bit worse for risk assets?
Oh, absolutely. And I think that you used a great phrase earlier, which is Fitch just turned the volume up on something that was already there. Nobody was paying attention to the fact that Treasury was talking about a big issuance until you had that combination of, oh, here's the big issuance, and oh, by the way, we have an issue. The expense for the U.S. government is much higher as well. They did not term out their debt like households did and like corporations did. That's going to be, excuse me, a big issue going forward. So the question, I don't disagree that higher rates, because the backdrop is not so good, because you've got more risk because I'm issuing so much debt, is not as good as higher rates because things are better and we want to continue to slow things down. I'm not sure how that plays out, but I don't think rates are going to come down to the extent that people want them to as fast as they do. And I think that's just going to be tricky for equities as well.
It's tradition. You know how we finish interviews together. We talk about energy. It's turning around. Energy's up. Saudis are pulling back and saying they might do that for a whole lot longer. We've seen some of the capital returns coming out, some of the energy players. I imagine you're feeling a little bit more comfortable about the call over the last couple of weeks. Can you walk us through why?
Well, there was a lot more supply coming in than I think anybody expected. Between us continuing to release from the SPR through this year, which we did, not buying anything back, which we had talked about doing, and other countries releasing oil, as well as so much Russian oil on the market that people didn't expect quite the level to be there, I think that kept prices lower for longer. And then you've got this back and forth between, if there's going to be a recession, demand is going to go down. Right now, that shift into it's going to be a softer, it's a soft landing and not a recession helps a little bit, but demand has picked up and the supply hasn't picked up commensurately. And I think that you're starting to see with Norwegian natural gas, right? So that picks up LNG. The entire complex is picking up. We thought that it was overdone, but with energy, it's very difficult. Those swings are big and they last longer than you think they should. And yes, we're feeling more comfortable, but we've sort of stuck through it. So we took some pain along the way as well.
Do you want to take a jobs guess this morning before you go? Do you want to pick a number? Any number. Whatever you fancy. Go
197.
On. There we go. Beautiful. Just short of consensus.
You get down to the 100, 197.5, 197.4.
Sarah, thank you. Sarah Hunt, good to see you. And Van Pine Saxon Woods. If you're just joining the programme, welcome to the programme. On Payrolls Friday, in the survey, the estimate at the moment, 200k. Equity futures on the S&P 500, higher this morning by 0.14%. Lisa, in the commodity market, need to talk about crude, 81.79 on WTI, and Brent
in and around 85 this morning.
Just adding to this feeling that maybe the actual physical crude market is not enough to really keep supplying demand at this level was yesterday Saudi Arabia coming out and saying they were going to continue the 1 million barrel per day cut in September. So this is what they're doing. And then meanwhile, oh yeah, Russia, which had been oversupplying the market, is basically, there are signs that now it's making good on the promises that it had made OPEC Plus to not supply as much. You put this together with the fact that nobody stopped traveling, as you can see from the airline tickets, and it leads to a, kind of a bullish proposition.
I agree with the bullish proposition, and I agree that every research article from 18 months ago talked about demand analysis. Sarah just talked about it, I think, very nicely. John, I went to copper, and of course, since, I haven't been here for a couple days, I did look at LME copper.
Ooh.
Just, because it is real copper. If you look at London LME copper, LMCADSO3, China has the symbol memorized. And the bottom line is we've had a copper recovery off of summer of last year. And that's about this global demand. And this is an undercurrent that's there, which is how Jeff Curry and others get to an elevated Brent crude price.
I do actually have that memorized. You're right.
I know. First time I said, this guy needs to get a life,
Look at Chicago.
HG1.
Yeah.
Simple. HG1.
Okay. Thanks for that. Just on flying, story of the week, I think. Elsewhere, sort of off the radar. Domestic. Not great. Not great, Lisa. Not great.
Cutting prices. And you're starting to see this. And that's something people are not talking about. But I want them not to talk about it because I want to keep enjoying the fact that they're cutting prices. Just
cutting prices. It's a secret. They're still really high. Nadia Lovell of UBS in the next hour on Payrolls Friday. The payrolls report, the estimate, 200K. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open. Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority. The markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays. The Fed is hoping for slowing job growth, but too much could spell trouble.
There is no way that many people would have predicted the kind of data that we witnessed.
Things have slowed down, but they're not falling off a cliff.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
Which nominal wage growth does the Fed need to see?
At what point do people start to say, this is not sustainable?
Maybe this will be the turning point.
The July Jobs Report, today on Bloomberg Television and Radio.
This was never supposed to happen in America. This is the persecution of the person that's leading by very, very substantial numbers in the Republican primary and leading Biden by a lot. So if you can't beat him, you persecute him or you prosecute him. We can't let this happen in America.
That was the former President Donald Trump after appearing in court in Washington, D.C. Wendy Benjaminson of Bloomberg News coming up very shortly, so look out for that conversation. I just want to work our way through the price action going into payrolls about an hour and 13 minutes away, with equity futures at the moment on the S&P 500 positive after a three-day losing streak on the S&P. The thankful news came from the likes of Amazon. That stock is up in a pre-market by, let's call it 8% this morning, 8.5% off the back of a beat and a raise. The disappointing news came from Apple, if you can call it that. We're down about 2.3% this morning, just falling short of estimates, and that stock just a little weaker in the last 10 minutes or so. We talked about the airlines and what's happening in America and abroad. If you're international, great, and you've heard that from some of the big players, the likes of United, the likes of Delta,